It's 9 a.m. live from the New York Stock Exchange. I'm Shauna Smith alongside Brad Smith, and this is Yahoo Finance Live. Here's your morning rundown. Well, bank earnings out this morning, and so far it's looking good. In a show of strength, JPMorgan enjoyed a notable 35% rise in profit. Wells Fargo beat the street on earnings, though was hit harder than anticipated by rising expenses. And Citigroup topped expectations amid its ongoing turnaround efforts.
At long last, a deal. Microsoft's $69 billion Activision acquisition has been approved by UK regulators. The deal was announced back in early 2022, a play to boost the tech giant's growth in cloud gaming. British officials blocked the move in April, but a few key concessions have now cleared the path forward.
And an impossible order. Israel's military is telling some 1 million residents in Gaza City to evacuate south within the next 24 hours, ahead of an expected ground invasion amid Hamas military forces in the area. Now, the UN calling the directive impossible, warning of devastating consequences. Authorities around the world on high alert today after calls from Hamas for a day of rage. We're going to start with the big driver of the market this morning, and that is the bank earnings that we got out. JPMorgan coming out of the gate very strong with its third quarter results. We're looking at gains of just about 1.5% in the pre-market. Revenue beating the street at $40.7 billion with adjusted earnings per share of $4.33. Net interest margins helping the numbers here. CEO Jamie Dimon calling it a, quote, solid quarter, also adding that these results benefit from our over-earning on both net interest income and below normal credit costs. Lots to digest in this report here, Brad, but clearly from looking at these numbers, especially the headline numbers, once again, JPMorgan really showing its dominance and why it is the leader here when it comes to the U.S. banks, at least right now. What stuck out to me, though, wasn't necessarily the headline numbers.
Sure.
It was some of the comments that we heard from CEO Jamie Dimon. And in this, he talked a lot about the economy, the consumer, saying that the consumer and businesses are healthy, but he did warn that interest rates may continue to climb even further from here. But perhaps what was most notable was what he had to say about some of the geopolitical headlines today, saying that this may be the most dangerous time the world has seen in decades with Israel and Ukraine. He also went on to talk about the attacks on Israel and the war in Ukraine, how that could have far-reaching impacts on energy and food markets, global trade, and geopolitical relationships. And I bring that up because clearly a massive, massive issue. When you talk about the ripple effects of this, what it could mean, obviously much more far-reaching than just the banks. When we're talking about the business impact, obviously, not the human impact, the business impact of all this, far-reaching, and almost every industry could be touched, if it has not been touched, by the growing conflicts right now.
Yeah, absolutely. And it continues to keep in mind a few of the things that the Fed has no control over.
Yeah.
The Fed does not have any control over geopolitical tensions that put further pressure perhaps on inflation. We have yet to really see that show up in the data. However, that is where a lot of the economists' thought process has gone. We're going to continue to discuss that with one of our guests later on during today's show. But particularly here in those comments, and I think you were right to point out really two of the big things that the Fed does have in its purview, and that is the consumer as well as the labor market right now, because he addressed Jamie Dimon saying we still do not know the longer term consequences of quantitative tightening that the Fed has gone down that pathway of, reduces liquidity in the system at a time when market making capabilities are increasingly limited by regulations here. But also here, you think about the consumer, saying the consumers and businesses generally remain healthy. However, consumers spending down some of their excess cash. We continue to hear that time and time again, that the consumer might not be breaking, but they are certainly bending and showing more signs of that. And then just lastly here on the tight labor markets here that we're continuing to track, JPMorgan CEO Jamie Dimon saying tight labor markets persistently, as well as extremely high government debt levels with the largest peacetime fiscal deficits ever, are increasing risks in their purview that inflation remains elevated and that interest rates rise further from here. So that is squarely what CEO Jamie Dimon, who previously was taking on a little bit of the meteorologist hat and giving us the economic weather report, but really being pointed in some of the language and the statement that he provided with today's earnings, even as we track JPM shares here pre-market. As of right now, we were just showing them to our viewers a moment ago, but for JPMorgan this morning, at least right now, pre-market, we're seeing a gain of about 2%. Speaking of some of the bank earnings that we're tracking here today, we got to talk about Wells Fargo. Higher rates also boosting Wells Fargo, the fourth largest U.S. lender, took home $13.1 billion in net interest income during the third quarter. And it boosted its forecast for that figure. Total revenue beat expectations at $20.9 billion during the period. CEO Charlie Schwab said that while the economy has continued to be resilient, we are seeing the impact of the slowing economy with loan balances declining and charge-offs continuing to moderate modestly. And so that in some of the numbers from Wells Fargo, but again here, I think when you think about Wells Fargo and where within some of the line items that I was tracking in the segment operations, they did see decline in some of their segments here year over year at least. And you think about the consumer banking and lending, it looked like that was down by about 10%. You looked at the commercial banking segment that looked like it was down by about 11%. So all in here, there are still, and especially within the wealth and investment management, and that could show where some of their customers are taking money off the table, especially coming off of August and September, which were certainly two of the more dismal months over the course of this year.
Yeah, certainly very important to point out there, Brad. And what's really sticking out to me, that the net interest income number there increasing 8%, primarily due to the impact of higher interest rates, obviously something that we heard from JPMorgan in their report as well, saying that though was partially offset by lower deposit balances. Another thing that sticks out to me was the provision for credit losses here in the third quarter, including $333 million increase in the allowance for credit losses. This is primarily for commercial real estate office loans. We talk about their exposure there to the space, what that means for the business here going forward. They also said that they also attribute it to higher credit card loan balances, which was partially offset by a lower allowance here for auto loans. So again, a good look at the consumer, a good look at commercial real estate right now, exactly what that play looks like here for these banks who do have exposure, more exposure maybe than some of the others here. But also what CEO Charlie Scharf has said about the economy, right? Yeah. Once again, yes, the banks are doing okay so far. Higher rates have been able to navigate the environment up until this point. But when you take a look at some of the spending patterns or some of the things that they're noting here about the consumer, the possibility for further weakness seems to be a common theme in these reports this morning. Well, we're not done yet because we also heard from Citi. So let's talk about those results here. Citigroup beating the street's expectations in the third quarter. Revenue landing at $20.14 billion. Now, it was strong growth with both institutional clients and personal banking customers. The numbers come at a pivotal time as Jane Fraser enacts an ambitious turnaround plan. We're talking about what went into Citi's results here for the most recent quarter. That revenue beat with both institutional clients and personal banking showing some strength. Their institutional clients, they reported revenue of $10.6 billion. That was up 12% on a year-over-year basis. Personal banking and wealth management division generated $6.8 billion in revenue, up roughly 10% on a year-over-year basis. Loan loss provisions coming in at $1.84 billion. So that was just a bit up here, up slightly from $1.82 billion at the end of the previous quarter. But like I said, one of those themes here of this earnings season, at least right now, it's day one here for the banks, but a theme at least this morning, CEO Jane Fraser saying that continued deceleration in spending indicates an increasingly cautious consumer.
This is a bank that's also restructuring itself right now, too. Jane Fraser acknowledged that within a statement. I mean, at that mid-management level, it seems like there are going to be more cuts that continue to be enacted as of right now as part of that previous announcement, saying that last month we announced those consequential changes that align our organizational structure with our strategy, changes how we run the bank, and then when they completed, they ultimately see themselves as a simpler firm, operating faster, better serving clients, unlocking value for shareholders. Shareholders want to hear that this morning. However, at the same time, it's a larger question and perhaps answers some of the questions around where they see themselves moving towards here and the areas that they're going to continue to maintain either the same amount of headcount or invest further in. You think about one of the segments that's been extremely important for them, this strength across the services and markets in institutional clients group, what they call the ICG here, plus the U.S. personal banking within that personal banking and wealth management business here. Revenues increased 9% from the prior year period, largely driven by that. And so that's perhaps giving a little bit of the inclination this morning of where this business and where the leadership is going to continue to lean into, even in spite of some of the organizational changes that they've had to make.
All right, well, let's keep talking about these big bank earnings, because once again, big bank earnings kicked off with a bang this morning. Strong showing from JPMorgan, from Wells Fargo, and from Citigroup. JPMorgan seeing profits surge 35% from the same quarter a year ago. Wells Fargo posting a beat after taking advantage of higher interest rates to counteract a slowdown that they're seeing in lending. For more on these results, we want to bring in Nathan Stovall, S&P Global Market Intelligence Director of Financial Institutions Research, and we have Dave Ellison, Hennessy Funds Portfolio Manager, joining us now. Great to see both of you. Nathan, let me start with you, and let's start with what we're hearing from JPMorgan. An extremely strong report here from the company. Profit up 35% compared to a year ago. What's your takeaway? And I ask that with my takeaway being, once again, JPMorgan really showing its dominance here at this point. Nathan, I think you might be muted. All right, Nathan, we're going to put you on hold here. We're going to go to, we want to bring in Dave. And Dave, I'm going to ask the same question to you, frankly. When you take a look at JPMorgan's results here, clearly coming in better than expected at both the top and bottom line, what was your big takeaway from the numbers that we're getting this morning?
Well, the takeaway is that the economy remains strong as we see all the numbers, and that's reflected in their loan demand and to some degree their credit performance. Let's remember that a lot of the analysts really have taken down their numbers, and so beating the numbers is relatively easy. And so I think that's, when they say they beat the estimates, I mean, Wall Street's been pretty bearish about margins and pretty bearish about credit. Certainly, they've had some bank failures this year to worry about. So I think we're in a situation where the worst of the margin pressure is over. Now we're sort of waiting for credit to kick in as the Fed, starts to, try to slow the economy. So, the disappointing thing is that JPMorgan was the best last quarter, and they'll probably be the best in terms of performance this quarter. So we're getting the best of bank earnings today, and the rest is going to be not quite as exciting. So, but again, it's a macro play, and that's the difficulty here, is that it's about rates, it's about credit, it's about liquidity, and all of that is controlled not by JPMorgan, but by the central bankers and to some degree the federal government.
Nathan, just as we stay on kind of this theme of what JPMorgan had to say, CEO Jamie Dimon not exactly saying, hey, this is going to be a glaring recession that we're heading towards, but is saying that currently U.S. consumers remaining healthy, but spending down some of that excess cash. Businesses, seems like the environment is getting tighter for them as well here. What do you extrapolate from those comments, and how do you kind of pair that up against some of what we've heard from economists in their own predictions for a hard versus a soft landing that could spell out recession?
Sure. The banks have effectively been over-earning on credit for some time, and I think Jamie is trying to throw out some caution, and we've seen that from other executives as well. They know that credit costs are going to go up, but the consumer has remained more resilient than I think most people have expected. Labor markets are more than most people have expected. The consumer's been able to digest higher rates better than most people have expected. So I'm not surprised that we're seeing that caution as they're trying to prepare the street. But we've also seen net interest income guidance raised by pretty much all the banks, including JPM. So I mean, it's a pretty strong beat from the banks here, but I think they're trying to prepare the street that you could see tougher times ahead.
Dave, let's talk about some of the proposed capital requirements that we're getting. That was one of the things that we heard a number of the bank CEOs weigh in on, most notably Jamie Dimon. He's never short of words, or isn't shy, I guess I should say, about his opinions in terms of what the impact could potentially be of certain scenarios. He was raising some questions just about the regulatory changes and the impact that that's going to have on some of the larger banks. More broadly speaking, though, in this sector, how big of a headwind do you see this potentially being?
Well, I've never, capital doesn't solve really anything in terms of making the banks better or worse. But I think it's a headwind from a multiple point of view, and a valuation perspective in terms of where they trade on book and earnings. And this industry is much about sort of earning money today as it is consolidating into the future. And so the value add of owning this space, which I've been involved in since the early 80s, has been the M&A activity. And by adding more capital or requiring more capital, you generally lower the valuations, and it makes it harder for M&A to be a value addition to the portfolio management style that you have to have in this space. So I think it doesn't necessarily hurt Jamie Dimon as an individual, but it hurts the ability of somebody like myself who's in the space to actually try to make money in it, because the M&A is a big part of why you own financials. And if you take that away through regulatory structure, it's not good for the investors.
Nathan, as we think about the banks right now and their international exposure, we heard Jamie Dimon acknowledge the geopolitical risk, the conflict as well. And it kind of takes you back to the first quarter of 2022, where this kind of instituted a wave of down guidance, or at least maybe some compressed guidance because of that concern or that risk. Do you think that this kicks off for this earnings season now some of the perhaps headwind that many executives see, and how that could impact their business as well?
I think we don't really know yet. I mean, I follow the logic of going back there, and it does rhyme with that a little bit of we're waiting to see what the impact could be. Does this make inflation sort of come back up and rear its ugly head? Does that mean higher for longer is not only higher for longer, but the Fed has to move more aggressively to temper inflation? But I certainly hope not. Thus far, it looks like we're seeing good strength here in the U.S., and I hope that we can stay insulated and that calmer heads can prevail in the rest of the world, and that things will not be as tumultuous as we've seen in the last few weeks. But I'm pretty hopeful that they might not have to act too aggressively, and that we might not be in a place that's too bad here. But it's certainly worth watching, and I think that's one of the reasons why you're seeing caution from executives here. David's point about M&A and new capital rules, that it's well taken, and it's definitely hanging a cloud over the space right now. One thing I would add to that, though, that we're hearing more from is the smaller banks actually getting closer to maybe a point of capitulation and seeing a restart of M&A activity, and maybe a little bit more consolidation from the smaller guys who don't want to bump up into this place. But David's point is well taken. That is something that is hanging over this group for sure.
Davis, are you nodding your head there? In terms of that consolidation, how quickly do you anticipate that is going to happen? And I guess to what extent are you expecting to see activity within the space?
Well, I think, as an investor in the stocks and not an owner of salaries and bonuses of the executives, the way you make money in this space is going from ugly to okay to good to great. And conditions now are good. They were great, but rates have gone up and made them more difficult. But the way you're going to make money, the way you're going to drive M&A is to have difficulty in the space. And you saw that with, for example, Silicon Valley, right? Silicon Valley, First Republic, SBNY, the companies that bought those companies have had significant earnings accretion, and the stocks have gone up. And so we need more of that. As an investor in the equity, I need more problems. I need credit problems. I need rates to go higher. I need the yield curve to stay inverted. I need the weaker companies to get weaker so that they can get merged into the better companies, and I can buy the accretive results of that. So I tend to be a little bit on the outside here thinking, okay, everybody says, well, I'm a boober and I want the things to go to hell so they'll get better. But that's the way you're going to make money in this space. You're not going to make money muddling through like you are now. Things are good, they're not great, maybe they get better, maybe they get worse. You're not going to make any money in this space under the current earnings situation, because they're good enough for the stocks to be where they are, but not bad enough for them to go down. And there just isn't a lot of new innovation. There's no new products. There's nothing wrong. So it's a boring space to be. And if you go back to the Silicon Valley back in March and April, it was a very exciting time because you could actually make money in the stocks that if you bought them correctly.
We're showing our viewers just a look at the bank heat map right now with some of the extended and pre-market moves here. Nathan Stovall, S&P Global Market Intelligence Director of Financial Institutions Research, and Dave Ellison, Hennessy Funds Portfolio Manager. Thank you both so much for taking the time here this morning. Appreciate it.
Thanks.
Well, third quarter earnings season kicks off, giving investors a little bit more food for thought amid growing conflict in the Middle East and the higher for longer interest rate debate and political instability in Washington. Our next guest says he doesn't think that this is the time to throw in the towel on risk assets, however, and would rather use this as an entry point again. Joining us now, we've got Max Kettner, Chief Multi-Asset Strategist at HSBC. So explain some of the logic to us just out of the gate here.
Yeah, look, I think, as long as growth expectations globally of some of those global major economies, let's say the US, the Eurozone in particular, as long as that continues to be really, really low, it's actually pretty good, right? That sets us up for a pretty low bar to beat from a top-down perspective. And you guys have been talking about the earnings season. And I think when we look at the expectations, we look at consensus expectations for the S&P. Look, consensus expects earnings to grow from Q3 to Q2 by about around 2%, right? And most of the downward revisions that people have made in the last couple of quarters have really been on the cyclicals, right? They've been on consumer discretionary, energy, financials. They've been on things like materials, right? So they've been pretty sizable downward revisions, particularly in those cyclical sectors. So I would say, as long as you've got this underlying pessimism, both in top-down growth expectations, but also in bottom-up expectations, this is not an environment where you want to be really sort of listening to every headline and become suddenly bearish on risk assets overall.
So Max, with that in mind, then I guess investors out there looking to put money to work in terms of timing, should they be worried about the timing of the market and where they're putting money to work? Where are some of the most attractive opportunities right now?
Yeah, look, I think the US looks pretty decent, right? The US equity market overall, particularly the large caps, right? I do think energy still looks pretty attractive, right? When we look across other asset classes as well, or other regions, I think Latin America still looks really, really good. It's got these value characteristics. You're benefiting from that structural nearshoring, friendshoring story, but you're also benefiting from a bit more sort of value and commodity exposure, right? It's got a lot of energy, materials in there, but also the banks. When we look at other equity markets as well, the UK equity market, it's got these defensive value characteristics, right? It's got a bit of commodity exposure, but it's also got the healthcare, the consumers in there. Consumer staples, it's got probably a bit more of a tailwind from the weaker sterling now overall. So there are quite a few opportunities. I would also highlight in other asset classes, when we look at high yield credit still looks pretty decent, right? In the US, you get close to 9% yield with very low maturities going into 2024, right? So it doesn't really set us up for a massive default wave that may potentially come in 2025. But for the next couple of months, we should be still fine, right? And that actually leaves high yield credit also in a pretty attractive spot.
Where does this strategy or thesis rely or bring in some of the rate policy and where that may move globally in the next few months?
Yeah, look, I think we're sort of flip-flopping around, right, between Goldilocks and what we call at least reverse Goldilocks. So either this environment where things are looking not too hot, not too cold, right, and things are actually pretty decent and certainly better than those consensus expectations that I've just referred to in the beginning. And then the opposite is a little bit what we've seen in September, right? That's the environment usually where you're saying, actually, nothing performs, right? All that you've got to do is going back into cash and long dollar and pretty much sell everything. And I think, we're going to be flip-flopping around between those two for the foreseeable future, certainly for the next couple of months. It does rely, I think, on the Fed not becoming overly more hawkish than the market is pricing, at least for the next sort of 2 to 3 meetings. So we don't see another Fed rate hike. I don't see a particularly great attraction for the Fed to hike further. I think what they want to, really tell the market much more is that rates will have to stay at these or at least pretty similar levels for quite some time, rather than keep on hiking, right? Really saying, look, it's going to take a little bit of time until consumers really feel the strain, until corporates really feel the strain. And the solution to that isn't really hiking rates much further. The solution to that is keeping rates at, or at least at similar levels to right now, for the foreseeable future. And with regard to that, that doesn't really affect our view too much, because what we've got to realize is that it's not really the level of rates, and in particular not the level of real rates, that has affected, for example, equity multiples in the last 3 years. It's really been the volatility of interest rates that has affected multiples so negatively in the last couple of years. So as that interest rate volatility goes down, that in fact should actually be quite good for multiples.
All right, Max Kettner, always great to get your perspective here. Thanks so much for weighing in this morning. Chief Multi-Asset Strategist at HSBC. Well, we're taking a look at some of the movers ahead of the opening bell. And first up is Microsoft on the move today. You can see it just above the flat line here ahead of the open. The UK clearing the tech giant's acquisition of Activision. Now, the $69 billion deal was blocked in April by the country's antitrust regulators. They said that it raised competition concerns. The deal is expected to close in the next few days. Clearly a massive victory here. Finally, I think Microsoft and Activision would say they've been waiting for quite some time to get that regulator approval here, Brad. Just about a year and a half, if you can believe it. Actually feels like we've been talking about this for just about 18 months. So that timeline makes sense. But there are still some questions just about the FTC and how far the FTC could potentially still go in their push against a deal, because they have made some comments and some signs here from Lena Khan saying that the FTC still is not going to give up.
Yeah, we've got a note as well from Activision CEO Bobby Kotick. He sent this to employees as well, saying that we now have all the regulatory approvals necessary to close, and we look forward to bringing joy and connection to even more players around the world. But the larger consideration here, and why this really sent so much of a conversation and concerted conversation and almost a tizzy through many of the regulatory watchdogs over the course of the last year and since this deal was announced, was to make sure that competition would not be squashed, because you've essentially got what is already one of the largest console players, which would be combining and is looking like they're able to combine finally with one of the largest title players out there in the creation and development of these games here. And so Bobby Kotick just going on to say we're excited for this next chapter together with Microsoft. Endless possibilities creates for gamers and for other players. And so all of that considered, I think it'll be interesting to tell with some of the concessions that they did have to give up in order to get this through. They ended up having to offload certain divisions and making sure that this still got and passed the sniff test at the end of the day. And so even with those concessions here, where this still creates a holistic environment for gamers who are moving increasingly towards streaming, continuing to see brand equity in a few games, and mobile still going to be one of the larger considerations for this industry at whole here. So Microsoft, Activision, seems like they've got the go-ahead and the all clear, at least as some of the approvals are concerned, pending the FTC, as you mentioned.
Pending the FTC, we know FTC says it's not backing down here in terms of some of the avenues that they're pursuing. The agency also pursuing a separate administrative challenge through its in-house judicial system. But we have to remember, though, a judge did rule against what the FTC was proposing, saying that the deal could go ahead here in the U.S. But again, that mobile gaming exposure, obviously one of the critical reasons, or the critical reasons to why Microsoft wanted to buy Activision. We're seeing that acquisition, it looks like, going through. All right, we got all your market action ahead live from the, I almost said the Nasdaq market, live from the New York Stock Exchange. We'll be right back. Just at the opening bell on Wall Street, let's do a quick check of the markets. We're looking at gains across the board for the major averages a minute here into the trading day. Diane King-Hall right behind us on the floor with a closer look at some of the moves. Diane.
Hey guys, well, Wall Street's off to the races this morning after a downbeat day yesterday. But what's interesting to note, there was some skittishness on the floor heading into this bell because there was some kind of issue that was causing a problem with order flow coming only here into the New York Stock Exchange. It's unclear if it was a technical glitch. It was resolved before the bell so that order flow could come through to the floor. And you think about the day. Today's Friday the 13th. So are there any kind of spooky vibes around that, if you will? But if history is a guide, the S&P 500 does typically post a gain on Friday the 13th. It is usually a small gain. It's usually up about 0.1%. As for where we stand now, as you mentioned, we are off to the races. Stocks on the plus side. You have investors putting that Thursday in the rearview mirror, looking to put a pin in what's been an upbeat week and more of an upbeat month when you compare it to the prior couple of months on Wall Street, but investors are expecting the S&P 500 to be pretty range bound for the duration of this month, really reading the tea leaves on where these earnings are. When you look at a couple of the sectors that are in focus, of course, a leader has been the tech sector. We're looking at XLK. That's been up for the week, actually, so on track to post gains a little over 2% for the week, so making marginal gains when you compare it to the broader market. Another area I'm looking at, financials. That's been in focus, of course. We have the big banks reporting their earnings. I know you guys have talked about them all morning, from Wells Fargo, which rang the bell today, to JPMorgan Chase. Taking a look at the action for the week, XLF up for the week, up about 2% as well. So investors really in kind of we're seeing a little bit of incremental buying action here, especially when you compare it to the challenges and concerns in the bond market and over financials in general. Is the worst of the challenges we've seen behind us this year, or is there more pain to come, especially as I know you all have talked about the issues with loan loss provisions and how those will factor in how the financials are doing. So I'll leave it there and send it back to you guys.
All right, Diane, thanks so much for a closer look here at some of the trends that we're seeing at the open. We want to get to another mover this morning, and that is BlackRock. BlackRock reporting its earnings results, and you're looking at some pressure on the stock with shares off just about 1.5%. Beat profit expectations with the asset management giant saying that its technology services revenue grew 20% on a year-over-year basis. But digging into some of these other numbers, revenue essentially was in line. It was up, yes, 5% on a year-over-year basis. Profit was up 14%, but some of the inflows or outflows is really what's sticking out to me in this report. Clients pulled $13 billion from long-term funds during the quarter. Net inflows for the quarter falling to $2.57 billion. That was down from $16.9 billion last year. Like $49 billion of net outflows for lower fee institutional index equity strategies here, including $19 billion from a single international client. So a lot to digest within this report. Not necessarily surprising when you talk about the fact that investors were very skittish, very nervous about what this quarter and what future quarters are going to look like when we talk about all the uncertainty out there right now. Here in the U.S., when it comes to Fed policy, also geopolitically, when it comes to some of the new risk that investors are assessing. But again, this report clearly not as strong as what we saw from the three large U.S. banks.
It's not, but I'm still excited. You know why? Because we finally have fresh commentary like this from Larry Fink, Chairman and CEO of BlackRock. A new earnings season has dawned on us. However, here's what he has to say, and this could set the tone for a few of the other banks that we have yet to hear from, even though we ran through Wells Fargo, Citi, and of course the behemoth that is JPMorgan earlier today. Here's what he says, and this could give you a little bit of the inclination around some of the investor mindset right now, saying for the first time in nearly 2 decades, clients are earning a real return in cash, can't wait for more policy and market certainty before re-risking. So what kind of trade, then, does that take off the table, man? Well, it might not mean rush back into some of the riskier assets that are out there in the market, but when you think about where BlackRock and where they're seeing and comparing periods like this of uncertainty to prior periods, they're looking back to 2016 and 2018 even. Remember the fourth quarter of 2018 and how dismal that was. So all of this considered here, I think when those clients are ready to put their money back to work, for where those risk assets get picked back up, naturally, tech is one of the first places that starts to get nibbled at, and then we'll see where else the major banks and investment houses are advising their clients to move towards, because we could see a larger kind of big trade initiated there. But again here, I mean, still looking across some, and this is also a big technology business too. BlackRock, Aladdin there, delivering benefits of scale to clients and shareholders, saying that they got margin expansion, 14% growth in adjusted EPS year over year, technology services growth as well, about 20% of the same period of time. Exciting time for
You sold me. You sold me.
Sold?
Yep.
Sweet. Done. Everyone, let's talk about PNC Bank. Good old Pennsylvania Bank here on the day. PNC Bank shares, they're moving lower though. Dang it, down by about 1.5%. This comes after the bank posted lower earnings for the third quarter, saying it expects inflation rates to impact the bottom line into mid-2020. The so-called super regional bank saying high rates will play a big role in business and investment and consumer spending. I didn't call them super regional just because I'm from Pennsylvania, but hey,
both of us
they
from
are.
Pennsylvania.
Both of us, exactly. Same area, greater Philadelphia area.
Yeah, exactly. When you take a look in this report, revenue coming up just a bit short. Deposits were also just shy of what the street was looking for here. The company, though, trying to get ahead of some of the tougher economic environment, tougher quarters that could be ahead right now, cutting their workforce by just about 4%. They're saying that they actually expect that move to save the company about $325 million next year for 2024. So certainly some fallout here from the higher rates, continuing to weigh on profitability here. Profit did top expectations. It is, though, down on a year-over-year basis. So important to keep that year-over-year comparison in mind here. And the reason why so many on the street pay close attention to PNC is because of the size of it, right?
Yeah.
It's the second largest regional bank. We know the regional banks certainly have been under tremendous amount of pressure at the start of the year. Started to see some stability over the summer, so certainly a lot of focus here on what we're seeing from PNC. So a bit shy in some of these headline numbers here. But again, I think given the environment, overall, not too bad of a report.
Yeah, and I think credit conditions, of course, continue to look at that over the course of this earnings season too, and how that's impacting some of the companies who rely on a good credit condition environment, as well as those who are trying to make sure that they're continuing to engage with clients. Credit quality performance here, delinquencies is something I'm paying close attention to as well. Delinquencies of $1.3 billion, that increased about 6%, primarily due to, get this, higher consumer loan delinquencies. So that's something that could be worth keeping an eye on for some of our viewers as we go on.
Yeah, and also ties into some of the commentary that we got from the larger bank CEOs also out this morning. All right, let's also take a look at Boeing, because shares on the move to the downside this morning, now off just about 3%. The 737 MAX quality problem for the company continues this week. There are more planes to inspect than the company initially anticipated. Now, Boeing saying that the incorrectly drilled holes are not an immediate flight safety issue, but the defect also impacts its delivery numbers, dropping them to the lowest since 2021 because the company is inspecting and fixing thousands of planes. We see that pressure on the stock once again today. And unfortunately, this is nothing new for Boeing. A number of setbacks, a number of quality issues here over the last couple of years, affecting the timeline, affecting the delivery number here that they're expecting over the last couple of years. Once again, not out of the woods yet, and we're seeing some of that concern reflected in shares today.
I mean, I can't be the only traveler right now who inspects the seat back pocket in front of me to see what type of aircraft I'm on when I get on there. And I have nothing against Boeing at all here. I think, especially here in the U.S., in terms of the comeback story that they have needed to be, and moving past the culture of negligence that came to light as a result of investigations following the two fatal crashes that took place of Boeing 737 MAX jets internationally here, and the grounding, and then the reinitiation of making sure that they could get back to airspace. It's a large story that we've covered for years at this point, and then getting back to deliveries. And so just continuing to make sure that they're dotting the I's, crossing the T's, and making sure that every one of those large plane orders that they receive, because this is a company between Boeing and Airbus, really accounts for over 90% of the large plane manufacturing and orders that come through. So they're amazingly important here. But I mean, there are some times when I get on a flight and I say, Jesus be an MCAS, because at the end of the day, there still is that concern that they have to go out and do quality control over the perception, the sentiment. However, I've still flown on A few of them successfully, and well, yes, thank goodness.
Well, you've probably never gotten off the plane once you realize
I don't think I've ever gotten off a plane.
You just might have been a little bit more sitting on the edge of your seat.
Yeah, I just pray.
No, but certainly, and that also is a huge issue here for Boeing, right? Just the customer backlash and whether or not people are willing or want to get on these flights because of the issues that they have had over the last couple of years.
Right, they were waiving change fees for a while, and so now all that considered, I think that it's been a tremendous effort by this new regime, this new executive management team to make sure that they are getting most of and getting a lot of that positive net promoter score back, especially among their largest customers out there as well. Everyone, we've got all your markets action. Today, we're live from the New York Stock Exchange. You see it right behind us. You see the fearless girl on the street? Is she out there right now?
Yes.
Is she just chilling? Okay, this is a live shot. All right, great. We'll be right back.
Bank giants kicking off earnings season. JPMorgan, Wells Fargo beating revenue expectations with help from higher interest rates. But new warnings, though, from bank leaders worrying investors. JPMorgan CEO Jamie Dimon saying that geopolitics and government inaction have led to a, quote, dangerous time, prompting it to prepare for a broad range of outcomes. Wells Fargo CEO Charlie Scharf warning of signs of a slowing economy. So what does all this mean here for investors to discuss this and more? We want to bring in Edward Jones, CEO Penny Pennington. Penny, it's great to have you back here on Yahoo Finance. I'm curious to get your perspective. We heard from a number of the leaders of some of the largest U.S. banks this morning, painting a picture of the fact that they're bracing for more of a slowdown. There are some signs that the consumer is deteriorating. What are you seeing in terms of an investment perspective and what your clients are preparing for?
Sure, Sienna, great to be with you and your audience. So Edward Jones, 8 million retail investors across North America. We sit in more living rooms and at kitchen tables and in our branch offices with more North Americans than any other firm working on their long-term strategy. So what the perspective is today is sort of a zoom in and zoom out. Our clients are concerned about, are we higher interest rates for longer? And there's some gives and takes to that in your investment portfolio, some goods and some bads. Should I be investing in equities? Should I stay in cash? We zoom in to talk about that with our clients, but then we zoom back out with them to help them put that into context for what it means for their long-term goals, saving for retirement, putting kids and grandkids through college, leaving a legacy from their portfolio. So just these last 2 days, for example, zoom in and zoom out. There's been lots of uncertainty, things to be concerned about, but keeping our clients focused on the long term is where we are.
Penny, great to have you here with us this morning, and particularly, would love to get your sense of what clients are asking you, your team, especially when we hear comments from the chairman and CEO like Larry Fink over at BlackRock saying that for the first time in nearly 2 decades, clients are earning a real return in cash, can wait for more policy and market certainty before re-risking. And so what is that all clear signal that your advisors would look for that re-risking to initiate?
Oh, so there's a bell that's going to ring? Wow, that would be really wonderful, right?
Outside of the one at 9:30 and 4 p.m., we don't know.
Exactly. So our clients are getting rewarded for risk off right now, for being in cash, for having CDs, for having money market mutual funds, and that sort of thing. However, with inflation rates still at 4%, a 5% rate on cash is not going to get you to your goals over the long term. So an appropriate diversification of some cash coming back into fixed income with interest rates probably going to moderate sometime next year. We'll be rewarded for that. And then turning our gaze to sectors in the equity markets that may be away from those magnificent seven that have soaked up all the ink over the past several months. There are opportunities in the marketplace, but diversification is the name of the game.
Penny, where do you stand just on the odds of a recession in terms of some of the indicators or what you're most closely tracking? How much of it is because of potential Fed policy versus some risk that maybe we don't even know about, or maybe one that's not necessarily on our radar yet?
Yeah, well, that risk is the one that is we can't account for, that unknown that might hit at any time. What we do look at is credit quality, pressure on that. We look at consumer spending naturally. We're seeing consumers spending on services and experiences. They're drawing down their savings rates at this point in order to spend on that, and that continues to be very healthy. But we also know that inflation is being impacted by those expenditures. And if the consumer were to become slightly more reticent in their spending, it would bring down inflation, but obviously have an impact on the economy at large. So it's those gives and takes, those push and pulls that we're looking for. We don't expect a deep recession. We do expect some slowdown, but we don't expect a deep or long-lasting recession.
Penny, I wonder what kind of flow activity you've seen recently. Are there customers who are reticent or who are hesitant to really pile more money into the market right now?
Mm-hmm. The flows have been into more risk-off kinds of assets, buying CDs, parking money in cash, beginning to look for municipal securities, for example, muni bonds, and the rates on those are attractive in some places. So we are urging our clients to remain focused on the long term and on good diversification. But again, they are being rewarded for fixed income investments where we hadn't been for the past several years.
Penny, when it comes to yields right now, clearly that's one of the topics that's dominating the street, dominating how investors are thinking about future opportunities. When you take a look at the 10-year yield right now, just right around 462, how much higher do you see it edging back towards that 5% level?
Mm-hmm. Well, this is all eyes on the Fed as well, right? So the Federal Reserve has made it clear that they're going to continue to fight inflation. They are a credible inflation fighter, and with inflation, with that 4.1% that we got yesterday, the Fed has still got some more work to do. Whether that requires another rate increase is left to be seen, because interest rates moving up the way they have is doing some of the work for the Federal Reserve. So we do expect that we are probably at near a peak in the interest rates, and we expect them to begin to moderate next year.
Penny, just quickly, we got to go here, but I almost track AI mentions like days without incident at this point. We got our first one in the earnings season here, and it came from Wells Fargo talking about their AI-powered virtual assistant. What is Edward Jones doing on the AI front, and how do you incorporate that into your model to the point where it either streamlines the customer experience or improves margins?
Right. So artificial intelligence is artificial because it's not human. And so we align it with another form of AI, advised intelligence. So artificial intelligence sits in the background. It helps us be more productive. It does help improve the client and the branch team experience so that we can spend more time in deep discovery with our clients. AI is going to be very helpful. Human financial advisors will not be replaced with AI, but they will be replaced by human financial advisors who are using artificial intelligence appropriately.
All right, Penny Pennington, Edward Jones, CEO, joining us here this morning. Thanks so much for taking some time here with us on Yahoo Finance. All your markets action ahead live from the New York Stock Exchange. Stay tuned. You're watching Yahoo Finance. Israel telling over 1 million Palestinians in northern Gaza to flee south within 24 hours ahead of an expected ground invasion. The unprecedented order applies to about half of the territory's population. Hamas, however, telling Palestinians to stay put. The terrorist group rules Gaza and is responsible for the killing of over 1,300 Israelis since a sudden attack took place last Saturday. After Israeli bombardment of the territory this week, more than 1,500 Palestinians have died and no water or electricity is running there. But where can they go in an area roughly double the size of Washington, D.C.? In southern Gaza, there is the Rafah border connecting the territory between Egypt, the territory and Egypt, rather. But that was bombed this week and has since closed. Reports saying Egypt is rejecting setting up safe corridors for refugees are emerging. So what now? Joining us now, we've got Yahoo Finance's Rick Newman with what's on his radar. Hey, Rick.
Hey, guys. Well, this is just getting uglier, as I think many people have predicted, and it will get uglier still. So people in Gaza, they can't leave. I mean, they're walled in, basically. Egypt doesn't want them crossing in over the border with Egypt. And to say that the people in the north of Gaza should move south, as Israel has done, that's like saying everybody in Brooklyn should go to Manhattan. What are you supposed to do? There's no place to stay. any kind of facilities will be rapidly overwhelmed if they're not already overwhelmed. And I think this is a prelude to what is going to be very troubling, which is as legitimate as Israel's effort to go after Hamas is. It's going to be civilians that are going to get stuck in the middle, and we are likely to see many civilian deaths in whatever comes next. This is going to be tough for Israel because, when Hamas attacked last weekend, full-throated support from the United States and many other countries, although not from China or Russia. But that's going to get a little iffier as this urban operation, this sort of clearing operation to eliminate Hamas gets underway. So everybody paying attention to this should gird themselves for some very unpleasant scenes that are likely to come up.
Yeah, very unfortunate, and like you said, one that we've unfortunately been bracing for now over this last week. A story clearly we're going to keep a very, very close eye on. Rick Newman, thanks.
Bye, guys.
Well, we got all your market action live from the New York Stock Exchange. We'll be right back. You're watching Yahoo Finance. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Brad Smith, live at the New York Stock Exchange just about 30 minutes into the trading day. So let's take a look at how stocks are trading this morning. And stocks Getting something of a tailwind thanks to strong numbers out from some of the banks, but bonds are also catching a bit ahead of an expected ground invasion by Israel into Gaza, marking a major escalation against the terror group Hamas.
Shares of Dollar General are on the up and up this morning. On news, the discount chain will bring back former CEO Todd Vasos to lead the struggling retailer. Shares are down nearly 60% so far this year, thanks to consistently declining profits and labor tension. But investors are optimistic that the return, or the new CEO, new leadership can right the ship. During his previous 7 years at the helm, Dollar General more than doubled its market cap and boosted annual sales by more than 80%.
We're also looking at shares of China e-commerce giant JD.com falling this morning after a slew of banks cut price targets and revenue estimates. Citi and Jefferies amid the firms that slashed their outlooks on the company, citing a weaker than expected recovery in consumer spending.
And checking out shares of United Health, the insurance giant boosted its full-year guidance and beat Wall Street estimates in the third quarter, with revenue up 14% from the year prior. And the health insurer has been on a tear since the summer, with shares up 17% since its last reported earnings in July.
All right, we want to bring you some market commentary that's sticking out to us this morning. First up, Treasury yields are down this morning, pulling back just a bit as you see some investors turning to the bond market for safety. Or investors are looking to de-risk, flocking to some of the havens on signs that Israel is gearing up for a ground invasion of Gaza. Now, the prospect of higher for longer interest rates boosted by yesterday's hotter than expected inflation data is also weighing on risk appetite. Now, in a note out yesterday, Bank of America strategist Michael Hartnett is saying that the U.S. stocks could avoid a big drop. They just need yields to stay under 5%. In such a scenario, the S&P 500 can continue to trade above 4,200 in the near term, but factors could drive the index below that level. Now, Hartnett flagging a stronger dollar, oil rising above $100 a barrel, and unemployment fueled by smaller businesses feeling the credit crunch pain. Obviously, all scenarios that investors are keeping a very, very close eye on. You mentioned that 5% level in yields, and that certainly has been a critical level here. We've heard that mentioned a number of times here at Yahoo Finance from business leaders, from strategists, from economists, just in terms of some of the levels that we need to keep in mind as to how much pressure that higher yields could put on the economy even further than they are now. Of course, that begs the question whether or not the Fed needs to hike again. But interesting commentary there. But like we said in that intro there, a lot of scenarios, a lot of unknowns that could certainly dictate the direction of this market in the short term.
Yeah, really interesting commentary from Michael Hartnett here. And I love the title of this note as well here. One of my pastors growing up would say, it's not good English, but it is good preaching. Superman don't need no seatbelt was the title of it. And particularly here, one of the things, if for those who are fans of the Magnificent Seven, we're looking for something to extrapolate from this note. You got that out of the second point, the zeitgeist here. Take out your Magnificent Seven, though, from the S&P 500 this year, and the index would be 3890 right now. You've got to look at it in the bottom corner of your screen right now. Yeah, we're well off of 3890. We're at 4364. So at this point in time, it just goes to show how significant the Magnificent Seven have been, especially in this AI wave, which is now transitioned into a show me story. So keep close tabs on that. Also, with the Magnificent Seven, just furthermore, at a new high of about 30% of S&P 500 market cap. That's important. They're trading at 30 times PE versus the rest of the S&P 500, which is at about 16x. So all of this considered, this could cause perhaps a reset or at least a reevaluation of how people are looking across some of the other names in the S&P. And as well, for the Magnificent Seven, if they don't show this quarter specifically that there is a pathway towards this larger AI wave that was in hype earlier this year, is now in show me, as we were mentioning, and now is going to need to trickle through to some of the financial performance and bottom line and margins here. I think that's exactly where you're going to need to see something said over the course of this earnings period that we've just commenced, where those big tech companies can deliver upon some of those AI dreams, goals and ambitions.
Yeah, certainly. And it's also interesting when you take a look at some of these flow numbers here, because we know that's something that the street very closely watches. Treasury is the largest weekly inflow that we've seen since March of 2023. So certainly a reversal from what we've seen in prior weeks. Obviously, a bit of a de-risking here, given the heightened geopolitical risk, given the fact that the inflation fight seems to be far from over. So certainly as something to note there as well as investment grade bond inflows of just under $1 billion versus high yield bond outflows of $2.6 billion.
Absolutely. Well, across the world, geopolitical tensions have hit new levels over the past week. Israel's military is telling 1 million residents in Gaza City to evacuate south in the next 24 hours ahead of an expected ground assault in retaliation against Hamas. Authorities around the world are also on high alert today after calls from Hamas for a day of rage. Meanwhile, the Ukraine-Russia war rages on. Moscow pummeling eastern Ukraine for the fourth straight day in its biggest offensive in 7 months.
The global supply chain had largely returned to a pre-pandemic normal in recent months, but growing divisions and splintering alliances now threaten to further shake up global trade and spark sharp fluctuations in commodities. To dive deeper into this, we want to bring in Jillian Tett, chair of the editorial board and editor-at-large, U.S. of the Financial Times. Jillian, it's great to see you here. So there's a lot to unpack of what we're talking about, this global conflict and exactly what that is going to mean for supply chains. Just first give us more of an overview of what investors, what business leaders are considering right now, given the recent escalation that we've seen in the Middle East.
Well, during the last few years, amid the whole COVID crisis, the first question on investors' mind was supply chains actually working or not? Because people wanted to know whether the goods were actually flowing along the supply chains and how much of a disruption and how much impact that it had on prices. But now the focus has really shifted to something else, which is that as the US-China relationship has worsened, there's been rising pressure on Western companies, particularly, but not exclusively in America, to source their goods from somewhere other than China. Now, initially, many Western companies thought, well, that's going to be too hard to do. We're not going to move too fast. But one of the things that the Russian invasion of Ukraine did was to really impress on everyone how quickly geopolitical schisms can suddenly flare up dramatically and force companies to make some really difficult choices. So what we have seen in the last couple of years is growing signs that actually Western companies have been reorientating their supply chains away from China. But up until now, it's been incredibly hard to tell just how significant that shift has been. And also whether they are essentially reshoring, as the White House has often said they should be doing, or friendshoring, or whether they're actually going through third-party countries like Vietnam and others to basically keep sourcing their goods from China, but in a more subtle way. So I've just written a column looking at that, drawing on a host of new research, both from the IMF, which is meeting this week, but also from groups like the Bank for International Settlements that have been tracking these patterns, these incredibly opaque and mysterious flows. The BIS has been using financial data to try and see what's actually going on.
Jillian, is there any clarity around how this could further impact inflation?
Well, I'm in the camp of those who think this is very inflationary, because if you dig down to some of the details of what the Bank for International Settlements research shows, and it's really the first type of bit of research that's trying to track what company statements are saying about their behavior. What you see is that companies have been essentially stopping the kind of one-step supply chain patterns we saw a decade ago, where they bought directly from China. What they're doing now is they are increasingly going through intermediaries in third countries like Vietnam and other Southeast Asian countries, or sometimes Mexico. And what that essentially does is insert a whole new number of new suppliers and new parts of the supply chain, making it ironically much longer and more complex. And one thing we know from everywhere in the business world, whether it's in medicine or finance or manufacturing, the more suppliers you put into a chain, the more cogs you have in that machine, if you like, the greater the chance of higher prices. You know, short supply chains are more efficient and they keep prices down. That's exactly why Western companies went to China in the first place. So I do think this is very inflationary. It may also be pretty bad for growth as well, because if you begin to see really serious rupture between different political blocs in the global system, you're going to see essentially more and more supply chains being disrupted, and that's bad for activity overall. In fact, the IMF reckons that if you saw a really serious schism between Russia, China versus the West, you could be knocking 7 percentage points off global growth going forward.
Jillian, when it comes to some of the things that business leaders are keeping in mind right now, when you talk about the complexity of the supply chain and the reshuffling that we're starting to see, how much does that then reduce transparency, and what is the trickle-down effect from that?
Well, that's a very interesting question, because there's been real pressure on Western companies in the last couple of years to essentially track their supply chains and make sure they are adhering to environmental and social standards. So you've seen lots of companies like, say, Walmart or Nestle really working incredibly hard to see what's happening further back along their supply chain and increase the standards there. But of course, it's pretty hard to do that if you've only got 1 or 2 steps in your supply chain. When you have multiple steps going through countries that traditionally have been quite opaque, and you're using lots of small and medium-sized companies and people that are essentially operating as intermediaries, it becomes much, much harder to see what's actually happening. So ironically, if you remember that the whole direction of Western business, the type of thing you'd be taught if you went to Harvard Business School in the 1990s and the noughties, was to make your supply chains lean and mean, one step, take out the intermediaries so you get more transparency, more efficiency. If you remember all that, then what you can see is essentially what's happening right now is that in some cases, companies are going into reverse. Now, it's possible this will give them more resilience. It's possible that they're learning to not just rely on one-step supply chains from China, but it's also possible that, as I said, we're going to see more inflation, more opacity, and potentially more complexity. And at the end of the day, many Western companies are still actually exposed to China, because if something goes wrong at one end of this chain, it will ricochet through.
Jillian, when we think about the state of kind of not just global conflict, but some of the geopolitical tensions that have come to head and come to this point, what does that do in terms of making sure that even in an environment where we've seen so much deglobalization, that there is a pathway forward for reglobalization or recreating ties and perhaps removing some of, not just tariffs, but some of the other headwinds that have kept countries from doing cross-border business?
Well, here's the thing. I think that almost every CEO on the planet right now is wishing that these terrible geopolitical pressures and strife would end, and that all this fracture and polarization and protectionism would somehow magically disappear. Jamie Dimon put it very well just now when he said that essentially, these are some of the most dangerous times that he's ever seen, that we've ever seen for the global economy, for anyone doing business. And of course, the human cost of what's happening right now in places like Israel and the Gaza Strip, and also in Ukraine, is absolutely sky high. It's appalling what's happening. Tragically, it's very hard to believe we're going to see any sudden return to the full globalized spirit we saw before anytime soon. We're dealing with a world of growing localization, or what Morgan Stanley calls growing not globalization but slowbalization, slowing down of all kinds of trading patterns. That's tragic. The one thing that is encouraging, though, and which may possibly provide some compensation, is the growth of digital links, and the fact you are still seeing connections around the world very tight on the internet. You're seeing the rise of things like 3D printing, and you're beginning to see people using the internet to find ways around some of the more negative fracturing that's occurring in the system.
Things that we will continue to track. Jillian Tett, always great to hear from you, chair of the editorial board and editor-at-large U.S. of the Financial Times. Thanks, Jillian. We got all your market action ahead live from the New York Stock Exchange. Keep it right here. You're watching Yahoo Finance.
Welcome back to Yahoo Finance Live. I'm senior health reporter Anjali Kimlani, and I just came back from the health conference in Las Vegas, which has grown every year, signaling the importance that digital health and AI are going to be playing in our future healthcare. I spoke to a number of experts who told me that investors and founders are really struggling with trying to figure out where the next big bet is. To that end, Vinita Agarwal, Andreessen Horowitz's general partner, talked to me about the role that medical experts are going to play in that role. Listen to what she had to say.
We're looking at an overstretched healthcare workforce. I'm a primary care physician myself. The inbox volume that most providers today are receiving from patients who appropriately have an expectation that they will be heard and heard quickly is almost unmanageable. And yet, when we look at our national statistics of number of providers per capita or health outcomes on that basis, we fall short. And we don't actually have numerically a provider shortage in this country. And so we are left with this strange sort of situation and tale of two cities, so to speak, which is that we've got lots of providers, and yet we're not achieving the healthcare outcomes and patient experiences that we want, nor the cost reduction that we want. And so bridging those exact two worlds, we think of a host of provider enablement technologies like AI that can be a co-pilot to our providers, that can take administrative burden off of our providers' plates, that can interface directly with patients in meaningful ways when providers otherwise wouldn't be able to. And all of those use cases we think are going to be powered by new and next generation AI models in a really impactful way.
But how this uncharted territory is going to be regulated by the federal government is still a big question that the industry is plagued with. And so I spoke with Amy Abernethy, the chief medical officer of Verily, as well as a former FDA principal deputy commissioner, about just how the government has to take a look at that. Listen to what she had to say.
FDA has been thinking about this and really trying to build its story of how they're thinking about it for a while now. For example, published an important paper in 2019 around their thinking in AI and ML capabilities. But some of the capabilities that we see now hitting the stage all across the health conference, right, have really started to accelerate the pace of being able to be brought into the healthcare space. And we're at this interesting place where FDA is trying to, in real time, develop the point of view of what regulation is going to look like, while what I call the speeding train of all of the AI-based software medical products are coming down towards this tiny tunnel of regulatory capability and scale. And it's going to be an important time. Last thing I'd say is, as a tech developer, I think about this from the perspective of, yes, in fact, FDA does have the responsibility as a public health agency. And so how do we, as tech innovators, help with that story as opposed to be afraid of it?
But technology isn't the only thing changing healthcare. We all know that Amazon is really making a move into this $4 trillion industry, stoking fears about how exactly it will disrupt the space and how it changes how we access care. I spoke about that with Neil Lindsay, the Senior Vice President of Amazon Health Services. Listen in.
Well, our mission is not to disrupt anything. We don't go into anything with the idea that that's a goal. Our goal is
You should tell everyone that, because they're all convinced you're going to disrupt it.
Well, we don't have a magic wand. What we do is we look at what are the experiences that need to be improved that we can make a difference in. And what we're good at is connecting the dots between people as customers and humans to the products and services they need. You do that in a general sense. And in healthcare, the need is the same, right? We need to connect the dots. Remembering also that 60% of everything we sell on Amazon is sold by a third party. Right. So we don't need to do it all ourselves. We'll do things first party where we believe we can elevate the experience. So Amazon Pharmacy, One Medical, we believe are elevated experiences where we can take our expertise and make a difference. When we, in Amazon, we often talk about selection, value, and convenience as key to making things easier. In healthcare, I've translated that to sort of choice, convenience, and continuity of care. That choice is important because it gives customers agency. One of the things that in a retail environment, customers do have agency. They have informed choice. Patients don't always feel like they have agency. They don't feel like they have choice. So we need to give them choice. Secondly is convenience. Convenience is key because if it's easy, people will engage. If they engage, they'll get better health outcomes. If they don't, they won't. And the problem is it's hard to engage right now. If it takes 3 or 4 weeks to get an appointment, if you have to line up with 15 other people who are not feeling well at a pharmacy and wait 20 minutes to get your medications, it's not easy. People aren't going to do it. They're just going to not get well.
Right.
And it's costing us a fortune as an economy. So, and then the final point is continuity of care. Ultimately, we all need and deserve that continuity of care that a service like One Medical provides. But to be clear, we're excited by wherever anyone gets their care. There's so much need in healthcare to make it easier that, we're working hard to do it in whatever way we can, and I celebrate anyone else who's making a difference in making it easier.
Speaking of making it easier, Wegovy, Novo Nordisk's very popular weight loss drug, has taken the world by storm, making it a lot easier for people to lose weight. But Hims & Hers, a popular telehealth platform known for its discreet prescription packaging, isn't buying into the frenzy. I spoke with the Chief Medical Officer, Dr. Patrick Carroll, and here's what he explained about why.
What we've realized, though, also with the GLP-1s and GIPs in a direct-to-consumer model, they're unaffordable, and quite honestly, the supply chain's a mess. Can you even access those? We have real doubts about that. And there are some side effects that are coming out that are concerning. So we wanted to kind of wait, slow down a little bit on going right to GLP-1s and GIPs. And so what we decided to do is to bring in an expert to guide us through this bill. We brought in a guy, physician, senior vice president of weight management, Craig Premack. He reports to me. He's built weight management clinics in Arizona. He has experience. He's a national leader in this. And Craig came to us and said, look, you don't have to double down on GLP-1s and GIPs. There are good generic medications, if used appropriately in the appropriate dose, and bundle that with a great education program, that you can have a holistic offering in weight management that is effective and affordable.
Affordability and Walmart, we know those two go hand in hand. Well, Walmart last week talked about these weight loss drugs and the potential impact on food sales. But I spoke with the Chief Medical Officer, Dr. John Wignasaran, about the long-term effects and what other impacts they expect from these weight loss drugs. Listen in.
If you're dealing with people that have significant obesity and they have a risk of a cardiac event and other, cardiovascular events, then having medications that reduce weight are really important. So I think on one hand, it's a great option for patients. On the other hand, we're still learning as an industry what these meds are about. So I had a career in pharma before I came to Walmart. And when you have a new medication that you're applying across millions of people, there are going to be things that you don't know. So I think all in all, great for patients. But I think what we're all trying to learn, and particularly here where we're seeing patients, trying to be very cognizant that we've got to learn more before we do more.
And while he didn't exactly address the claims about the impact to food sales, we have heard in the past week that those claims may be a little bit overblown, still waiting for more details on the data that Walmart used. But all told, really an interesting, a field of AI, digital health, and other aspects of the healthcare system, making it much easier for us today as patients to access the healthcare system. We'll be keeping an eye on all that and more for the future, of course. But don't go away. Yahoo Finance Live is going to be back with more markets and trading action.
Good morning. This is Yahoo Finance.
Big news. 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You gotta scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned.
into Yahoo Finance. Welcome back, everyone. You're watching Yahoo Finance Live. We're watching shares of United Health this morning after the insurance giant saw revenue jump 14% year over year in its third quarter earnings and boosting their full year guidance again. For more on what this signals for the healthcare sector, we're joined by Megan Fitzgerald, Great Ghost Advisors, PE investor, and Columbia University healthcare policy professor. Great to have you here with us this morning, Megan. First and foremost, when you think kind of broad strokes about this report, what it signals for the rest of the reports that we're set to see from the healthcare space as we go deeper into this earnings season, is there anything that we should extrapolate and apply to the broader sector?
Yeah, well, I mean, United always goes first, and when they go strong, as you said, they can tend to be a bellwether for the rest of the industry. So I think those with a similar book that have, insurance, that have physician enablement, manage physicians, that manage, vertically integrated healthcare, quite frankly. You're giving care, you're insuring patients, you're taking care of their prescriptions. So I think those that have similar strategies will probably benefit. And this was a great earnings, I think, for United. Top line grew 14%. This is the strongest top line growth I think they've seen since 2016. Return on equity was 28%. So it's a 20-year high for United. So I think a very good print for them, and really, I think underpins, a bullish sentiment for their strategy all around.
Megan, a big focal point in this report and really amongst many of its players out there is medical expenses, because we know United Healthcare Management had warned about rising medical expenses given the fact that many people were getting procedures that they had put off during the pandemic. When you take a look at these numbers here, the spending wasn't as high as the street has been bracing for. Is this a trend that you think is going to continue here this current quarter, looking out into 2024? How are you looking at the factor of medical expenses and whether or not that could potentially rise and be that headwind?
Yeah, great question. By the way, I thought last quarter they would put up a different medical loss ratio, and they beat it. And once again, right now, they beat it. So I think many people were surprised. And again, it's to the testament of how well they're managing things. But a big question was, how are they going to manage the GLP inhibitors? And as patients get more chronically ill and they return, kind of from their COVID hibernation of getting surgery and getting good care, would that trend in the wrong direction? So far, not the case for United, but certainly something analysts and the street will continue to look at.
Megan, is there anything that we got in terms of guidance that gives us any type of insight into where, for the consumer that is relying on not just healthcare, but also monitoring their own costs, either the premiums or the amount that's out of pocket that they end up paying, especially in a more kind of concerted and conscious decision-making factor about where they're spending, what they have to spend into versus what they want to spend into, where healthcare is sitting within that, and anything that United Health is giving in terms of some clear kind of mindset around that and what they're seeing from consumers and their insured.
Yeah, well, most of the earnings upside for United came from the insurance group. They did point out that they had only added 2 million consumers this quarter, which was a 2% growth. But what they said, which was interesting to your question, is that the revenue per consumer was up 27%. So consumers with them are spending more, which does talk to our consumers really feeling this because they're spending more. So I think that's just an interesting data point to watch, because most consumers I know and family members tell me that insurance has gotten more expensive. Their premiums are up, their out-of-pockets are up. But for United, that hasn't really hit them yet. I think the big question, once again, is how they're going to manage the GLP inhibitors, which are very expensive and ostensibly could see half the population go on them.
Yeah, Megan, how are insurers, any insight in that, assessing how they are going to be handling the pricing of this and the types of conversations that are happening right now between the pharmaceutical companies and the insurers, just in terms of trying to make the drug available to what has been projected millions of Americans who would be interested in taking one of these GLPs?
Yeah, I mean, what's interesting right now is 10% of the biotech, biopharma market is Novo and Lilly. And that really is due to the GLP and the GIP inhibitors or antagonists. So I think it's a fair question to say these are here to stay. Every week there seems to be new data that they're affecting patients in a more positive way. And right now in the United States, the highest causes of morbidity and mortality are around obesity, diabetes, high lipid levels. So if these products can show that they really bend the cost curve in a meaningful way, I think we're going to start to see Medicare and insurers have to cover them. What I'm hearing from a conference last week is they'd like them to be at risk. They'd like to do some type of value-based care arrangement where the impact on the patient is what they pay for, not the $1,000 a month payment. And right now, you haven't really seen many of, the pharmaceutical companies lean into a pricing scheme where it would be paid for performance. Right now, they're just basically enjoying the benefit of so many patients needing this and benefiting from it. And their concerns would be not to run out of supply, to fire up manufacturing to make sure they run out of supply. But I'd imagine as we start to look at Medicare negotiations and what happens, that book of business, whatever is constructed for Medicare would also then bleed into the commercial book of business.
Megan, given the fact that we acknowledge that this is such a major healthcare industry bellwether in United Health, and they acknowledge that there are going to be individuals that are impacted by ongoing state-driven Medicaid eligibility redetermination processes going into next year, a general election year, where once again it seems like Medicare is going to be a political talking point. What type of pressure, what type of volatility does that place in the mindset of investors around a company like United Healthcare and some of the others?
Well, United Healthcare has such exposure to all classes of reimbursement, whether it's Medicare, Medicare Advantage. Some people were worried about how they could manage Medicare Advantage. Last 2 quarters, they seem to manage just fine. And I think, just from a public health perspective, we still have 20% of adults that are poor in the age 55 to 65 range that do not have insurance. So states are going to be forced to think about how to cover them and give them access. And I think anyone in healthcare, whether you're a payer, a retailer, a hospital, we all want people to have good insurance coverage because we don't want to just see them when they have an emergency event. So I think anyone in healthcare has to learn to manage Medicaid because the business is so significant in terms of the lives are covered. And most likely anyone that is uninsured, if they have any path to getting insurance, would be through state Medicaid. And so to your point, it'll be a highly political issue, but one that we absolutely have to work through because people still die because they're not insured. And the leading cause of bankruptcy for Americans is when they have an incident of cancer and they go bankrupt because they can't afford their treatment. So I think more to come on that, but strong companies like United have shown an ability to manage through it.
All right, Megan Fitzgerald, always great to get your insight. Grey Ghost Advisors, thanks so much for joining us here this morning. All right, we'll keep right here on Yahoo Finance. We got all your market action live from the New York Stock Exchange. We'll be right back. Oil prices spiking higher today, up nearly 4%. A couple of things going on. One, conflict in the Middle East, exactly how that's going to play out following Israel's calling for the evacuation of over 1 million people from Gaza. That is driving oil prices to the upside, as well as new sanctions here on U.S. crude exports, raising some supply concerns in what is already a very tight market. So here for more on what this means for energy prices, we want to bring in Ines Ferre. Ines.
Yeah, Shauna, and let me start out with that second point that you just touched on, those price caps that the G7, the coalition that includes the US, Japan, France, Germany, et cetera, some other countries, as well as Australia. Those price caps were put in place against Russian oil exports last year. And basically what it says is that vessels cannot carry Russian oil that is above $60 per barrel. So that price cap is intended to restrict the funding for Russia, for that funding that would be presumably going towards the war in Ukraine. Now, the U.S. and the other countries within the G7 have said that there are two companies that have vessels that were carrying Russian oil that was priced above $75 a barrel and $80 a barrel. So basically, a crackdown on those companies and companies that were violating that price cap. The U.S. here is seen as cracking down on Russian oil, and that is putting the U.S., though, and others in precarious situation because, of course, when you're taking out supply from the market, that's difficult when you have seen prices go up high. So, which brings me to my next point. Going into this weekend, a lot of uncertainty. Of course, the counterattack by Israel against Hamas in Gaza, that is widely expected. But there's uncertainty around the conflict. And namely, there has been uncertainty this week on whether or not Iran, which is a known ally of Hamas, was involved in any way against the attacks on Israel. Now, interestingly, Iran recently said that it has increased its oil production from about 2 million barrels per day back in 2020 to 3.2 million barrels per day today. And the U.S. has basically turned a blind eye around this issue. Now, Andy Lippo of Lippo Oil Associates is saying to me that, look, the U.S. can't afford to take oil supplies off of the market because that is going to result in higher gasoline prices. And we are going into an election year next year. So a lot of uncertainty in the market. And what we have seen with oil this week, the spike we saw on Monday was around the Israeli-Hamas war broadening to other countries, namely to Iran, and what that would do to the oil market.
Inez, how quickly do we typically see a pass-through to gasoline prices? We're taking a look at futures in the move here today, largely mirroring what we're seeing in the oil market and energy prices here. But how soon typically is there a pass-through to what people are paying at the pump?
Yeah, look, that saying goes that prices go up like a rocket, they come down like a feather. So you could see price increases relatively quickly, especially because Iran is a player here in the oil market, world oil market. You also have the Strait of Hormuz. That if that were to be impacted in any way, you would see oil prices shoot up, and that would have a significant impact on gasoline prices relatively soon. I wouldn't say that you'd see that tomorrow, but you would see that within the next couple of weeks. Again, this is a thorny issue for the administration. These gas prices, they have been coming down. We have had analysts that have been saying that you would see them come down significantly, but this just throws a wrench into the situation.
All right, Inez, thanks so much for continuing to cover the space for us and bring us updates here. Appreciate it. We've also got an update from UAW President Shawn Fain in the last few minutes saying that while they are not announcing any new expansions today, the union will no longer wait until Fridays to announce new strikes. Yahoo Finance's Pras Subramanian has more of these details. Pras, you were listening in. We didn't get a new music video today, but we did get some significant announcements from the UAW.
Yeah, it's still ongoing, Brad. He's still talking, Shawn Fain, the UAW president, like you said, mentioning that they're done waiting until Friday to expand their strikes. I'm going to read a couple of lines of what he was saying today. No longer going to use Fridays to announce new strikes. We'll stand up at any time. Tomorrow, they're calling on all UAW members to head to current picket lines to mark 1 month of strikes. Fain also said that the companies are waiting until Friday for counteroffers. That's why they decided to, you know what, we're gonna hit you now because they think that they want to kind of disrupt how the big three have been sort of approaching the negotiations. They want more urgency there. And he mentioned that on yesterday when they went to on Tuesday when they went to the Ford negotiation setting there, Ford did not offer them any new money And they said, you know what, that just cost you Kentucky truck plant, and they walked out the next day. Also want to say that they said that when we're referring to Ford saying that they have reached their limit, Bain said that the workers have also reached their limit, and that's why they're escalating these strikes now. As I said, working 1 month tomorrow.
And Praz, when we talk about the UAW strike, where the talks stand right now, we know one of the critical issues that has been discussed is how the UAW workers are going to be impacted when we talk about the industry's transition to EVs. And we're starting to see more and more mainstream adoption when it comes to EVs. We actually just got new numbers out today, and it looks like demand actually picking up pretty quickly.
Yeah, in Q3, Cox Automotive said that the EV sales in the U.S. crossed 300,000 for the first time. It's a record for the U.S. in terms of EV sales. And interestingly enough, Tesla sales still at 50%, but they've fallen down considerably from the low 60s in Q1. So we're seeing that the pie is expanding, more sales are happening. We're at around 8% total U.S. market share is EVs. There you can see the sort of the brands that have, other than Tesla, that are seeing their EV market share rise up here. But Sean, I got to mention something that, 8% is nice, but I think what really needs to happen is 10, 15, 20. And I think what's happening is we're seeing a sort of barrier hit with, at least in this country, because of the prices. That's sort of a big deal that we've seen with our Yahoo Finance Ipsos poll that came out this week, that cost is a major concern, and these cars are still above $50,000 on average. Once you start seeing the 40,000, maybe even 30,000 limit, might see some more adoption there. But I think that's sort of the critical limit is, can we get above 10 and then 15 at that?
Yeah, certainly. We talked a lot about the need to get the prices of these EVs down in order to get more people able to afford them and increase the number that we're seeing on the roads here in the U.S. Praz, great stuff. Thanks. Well, we got all your market action ahead live from the New York Stock Exchange. Keep it right here. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement. What happens now?
I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings, and they give you information if you watch them closely.
President Bostic, President Investor Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there's more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space.
Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story. What does all this mean for you?
Keep it tuned into Yahoo Finance.
If you couldn't make it to the tour, have no fear. Taylor Swift's record-setting concert is in movie theaters starting this weekend. Now, the Eras Tour concert film has already secured big ticket sales at the box office. Here with more Yahoo Finance's Alexandra Canal. And Allie, a lot of happy and excited Swifties out there. They've been waiting weeks for today.
You're right. A lot of happy Swifties. Taylor Swift Eras Tour officially here. We have the LA premiere on Wednesday, early access shows on Thursday, and now the official wide release today, Friday, for all those Swifties. And in terms of the box office, this movie is already crushing it in ticket sales, $2.8 million in previews alone. IMAX revealing that more than 350 shows are already sold out, with well over $100 million in advanced ticket sales. We did ask IMAX CEO during our Taylor Swift special what this demand ultimately means, and he said that the box office has seen this demand before, but for blockbuster films, not necessarily a concert film. So it's this unprecedented phenomenon that certainly set a new bar and has opened up a new window of opportunity for theater chains, especially at a time when a lot of these theaters, they're really struggling for content. We have the actor strike still ongoing. The writer's strike just ended after nearly 5 months. Studios have had to reshuffle a lot of their release schedules as a result. And we have seen major films such as Warner Brothers' Dune 2, for example, move into 2024. And that's not great, especially after we had a summer that was so strong. So concert films like Taylor Swift's offer that boost that cinema chains are ultimately looking for. And she's not the only one. We're going to see Beyonce's Renaissance tour at the end of December. So the girl summer that we saw is continuing well through the winter. But certainly this is going to be a big one this weekend. And I expect some pretty high numbers on Monday after we see who ultimately shows up and shows out for this concert film.
Oh, they're going to show out for sure, Allie. Look, when we think about our conversation with Richard Gelfond, the IMAX CEO, about this and the excitement that executives are having, and even to the point where I had seen some of the waiving of certain rules that are in place. I didn't even know about these coming into this this theater experience, where at Alamo Drafthouse, I heard that they're waiving the rule where you got to sit down, you got to basically shut up while you're in the theater. And they're saying, hey, you could get up, you could dance, you could party. I mean, how much, not just fanfare, are the theaters expecting to really generate from this, but then how many kind of recurring, perhaps? There could be people that come multiple times to see this.
Oh, absolutely. People went multiple times to the actual show. So I certainly expect that people are going to go to the theater multiple times. The film is 2 hours and 48 minutes long. Okay. So a nearly 3-hour movie. I did see some videos, some snippets from the LA premiere. People are on their feet. They are dancing. They are singing, and they are dressed up, sharing their friendship bracelets. I mean, it's basically going to feel like you're at the concert. So this is a great opportunity for those folks that weren't able to get tickets, myself included. It was very, very difficult. Now they have the opportunity to get in on the action and really experience this cultural moment. And look, live events, they've exploded, especially in this post-pandemic era. And I think this concert film is just another example of that demand right now.
All right, I see you're at one of our remote locations right now, so you can't ask Josh Schaefer if he's gotten my friendship bracelet that I sent him yet. I'll just ping him on Slack after we wrap up here.
I'll follow up with him.
Okay, please report back on that. Allie Canal, thanks so much for the update. We appreciate that. All right, everyone, let's take a quick check of the markets here as we close out the hour. I want to take a look at the Wi-Fi Interactive here as well here, just to give you a sense of where we're seeing some of the activity proceed forward. Here you've got the major U.S. markets, the major averages mixed as of right now, but taking a look at some of the sector activity as well here, as we've got that fired up here for you on the Wi-Fi Interactive. Energy right now, it's up by about 1.9%, leading the pack. We are mixed here. However, it looks like we have more laggards than gainers. XLY, that's the consumer discretionary sector, pulling up the caboose. Just a quick look at XLF, though, here, as we got some of the banks kicking off earnings season. You're seeing that up 0.6% right now, Shauna.
You've been waiting all show to do this.
I've been waiting for this.
You've been asking our producer every chance you get when you can pull up the heat map. So you finally got your wish right before the end of the show.
Yes.
You were able to squeeze it in there. All right, guys, thanks so much for tuning in to Yahoo Finance Today. Keep right here on Yahoo Finance. Akiko Fujita has you for the next hour. We'll see you on Monday. Have a great weekend.
Welcome to Yahoo Finance Live. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here's what I'm watching at this hour. Cashing in. Big bank earnings kicking off with a bang this morning with strong results out of JPMorgan, Wells Fargo, and Citigroup. What that signals for the earnings season ahead. Political chaos. Congressman Steve Scalise drops out of the run for House Speaker as he fails to secure the necessary votes. With the government shutdown looming, what happens now? Plus, the final offer. Ford says they've reached the end of the road in negotiations with the UAW after offering a 23% raise to union workers. We'll discuss what this means as the auto strike pushes on. But first, let's take a look at how markets are faring here 90 minutes into the trading day. On this Friday the 13th, Dow up 37 points, the S&P 500 down 11, and the Nasdaq down 100 points. We are watching financials closely today, getting a big lift on the back of those strong reports from JPMorgan, Citigroup, and Wells Fargo. Energy also seeing a big move today in the session. Take a look at where oil prices are trading. WTI $86 a barrel. Brent crude looking at $89 a barrel. These big moves coming on the back of the U.S. tightening sanctions against Russian oil, adding to supply concerns in the market. Of course, we are continuing to keep a close watch on Treasury yields today, seeing a pullback, particularly on the longer end of the curve. The 30-year yield pulling back about 8 basis points at 4.79 right now. Well, as we mentioned, big bank earnings kicking off with a bang this morning. JPMorgan, Wells Fargo, and Citigroup reporting its latest round of Q3 results. JPMorgan saw profits surge 35% from the same quarter last year. Wells Fargo posting a beat after taking advantage of higher interest rates to counteract a slowdown in lending. So, what do these results signal about the overall health of the U.S. financial system? Let's bring in Yahoo Finance's Inez Ferre for some answers. Inez.
Yeah, Akiko, and as you just mentioned, JPMorgan announcing its results, and we're seeing the stock higher. And analysts have been commenting on the earnings, and also JPMorgan's Jamie Dimon's CEO, his comments as well. He did comment about the war in Ukraine and about also the Israeli-Hamas conflict. But looking at some of the commentary from analysts, so you've got Evercore ISI that writes that the firm continues to defy gravity, but sends up some caution flags, talking about the results overall, though, being pretty darn good considering the backdrop. Piper Sandler also saying that all told, another very solid quarter with an improved outlook. And just looking through the earnings call as well, Jeremy Barnum, the CFO of the company, he was asked about the scenario of recession, about credit, and about seeing some softness on the consumer or on the commercial side. And the CFO basically saying that their economists had as their central case outlook that included a very mild recession. And he said, we're still they still have their reserve at a significantly higher unemployment rate on a weighted average basis, but that's their central basis outlook. Also talking on the call, saying we continue to see the normalization story play out and consumer more or less exactly as expected. Taking a look also at some of the commentary that came out of Citi posting a better than expected revenue, expenses, and profit. Its fixed income trading jumped 14%, more than 4%. That's more than a 4% increase than expected. And looking at what the Citi's management was talking about, Citi warned of an uptick in credit card losses in the fourth quarter. Now, having said this, the bank beat earnings estimates on better than expected revenue and strong trading, investment banking, and also net interest income, as I mentioned, Akiko.
Yeah, and as you know, even though we're seeing those three major banks at least getting a lift on the back of the results, the reality being that credit is tightening, continuing to tighten. We saw some of that reflected in the numbers. What did we hear from some of these banks, particularly about loan losses and what their expectation is going into year end as we continue to see the effects of the Fed's policy take hold?
Yeah, and as you were just mentioning that, also, I just want to mention something that regarding some of this commentary from management. Mark Mason, CFO of Citi, talking about that the bank still expects a mild recession in the second half of 2024, but that the labor markets are holding up for now, and that the consumer has been resilient. The banks have been preparing for, they're very prepared for loan losses. And we have seen that they're, as I mentioned, they have their reserves that have been higher in the expectation of loan losses. But we have seen tightening credit for certain. And big part of the industry that they're looking at, of course, is the commercial space as well, and commercial real estate as well, which is something that we know that has been in distress.
Yeah, certainly going to be a big concern and a focus moving forward. And that's Frey. Thanks so much for that.
Thanks.
Well, sticking with banks, shares of PNC are falling this morning, down about 2.7% there. The regional bank posted lower earnings for the third quarter, blaming its weak results on low trading revenue, loan syndication, and merger and acquisition revenue. The company sees higher rates playing a big role in business investment and consumer spending to impact their bottom line going into mid-2024. For more on PNC earnings, I'm joined by Alexander Yoakum, CFRA Research Senior Equity Research Analyst. Good to talk to you today. What was the one line here that stood out to you? Any real surprises in the results?
In terms of surprises, I wouldn't necessarily say that, but there was a little bit of weakness on the balance sheet. If you look at deposits and loans, both down. There's been a lot of talk about loan growth slowing, and PNC is heavy in commercial loans. So think like businesses, and businesses don't want loans right now. They're holding out hope the rates will fall, and it hasn't happened. So we saw some pretty weak loan balances, actually loan contraction for PNC. And then on the deposit side, there was some weakness there. And, there's been a story about rising funding costs. We've seen that continue. And for PNC, non-interest bearing deposits continued to run off, which is a concern just because, those, if you can get non-interest bearing deposits into loans, that's very profitable. So when you lose those, it tends to hurt.
Going back to loan balances, they're certainly a good pulse when you look at these numbers, given that it is the second largest regional bank. I mean, what does that tell you about a further slowdown in the current quarter, given how quickly credit is tightening right now?
Yeah, honestly, there's been a slowdown for pretty much every category outside of credit card. Now for PNC, also some slowdown there, but in general, across the industry, credit card has still been strong. But yeah, I mean, with rates higher, we've definitely seen a big uptick, on higher yield. At the higher end of the yield curve, not today or the last few days, but over the last few weeks, definitely an increase there. So yeah, loan demand is down, and as long as rates are this high, we wouldn't expect, strong loan growth for banking in general over the next few quarters.
With regional banks, certainly commercial real estate in focus, given the exposure with so many. You've highlighted the fact that, this bank specifically doesn't have the kind of exposure to office space, which is the big concern here. What does that look like? I mean, there's been so many doom and gloom scenarios that have played out there. How is PNC positioned in the broader landscape when you consider the concerns around office space?
Yeah, so I would say the concerns over office are real. Office is struggling. Office will have large defaults, but you have to remember, most banks do not have large exposure to office, right? So PNC has 2.7% of all loans in office. So what we saw this quarter is there was a deterioration in office, there was a deterioration in commercial real estate, but net charge-offs actually declined at PNC, right? Because their portfolio is so large, so diverse, and the rest of the portfolio was actually performing well, they actually did okay. So it is really important to always look at, what percent of the portfolio is in office. And, for a bank like PNC, because the rest of the portfolio is well, they're reserving for really catastrophic scenarios, where office values fall 75%. They can do that when just a small percentage of their portfolio is struggling. If we start to see credit concerns in other categories, that's where there could be real concern. But for now, it's mostly still pretty strong.
We are, of course, several months removed from what we saw in terms of regional banks. The SVB collapse, feels like things have stabilized a bit more. But when you look at across the board on regional banks, where are you seeing the biggest pain point, especially with these rates pushing even higher? And are we likely to see further consolidation?
Yeah, so pain points is definitely rising funding costs. So you'll see at the large banks, they have excess deposits. They really loaded up on deposits during the pandemic. So even though they're seeing outflows of deposits, it's relatively okay. For the regionals, they have less deposits. So when those run off, it hurts more. You see the net interest margins of these smaller banks really get hit. So that's an issue. Another issue is there's expectations of more regulation, following the collapse of Silicon Valley Bank. And there's expectations that some of these securities losses or unrealized losses are going to be required to be added to capital ratios, right? So Silicon Valley Bank, their capital ratios were strong. But if you looked at their securities, it would have made their capital ratios worse, right? So this is something that we're now looking at, across the industry for regional banks. And a lot of regional banks have pretty large unrealized losses, and that hasn't helped because long-term rates have been rising. So those largely increased in the third quarter. Again, not so much for PNC. They're very well, they have a strong history of managing risk, so they didn't really load up on these securities. But a lot of other regional banks did load up on these securities, so they're struggling there. In terms of M&A, it would be an attractive environment. A lot of these banks are trading at lower multiples, but most banks are being pretty cautious right now, right? They're trying to increase their capital ratios. They're not necessarily in offensive mode. Most banks are in defensive mode right now. So I wouldn't expect necessarily too much M&A this year.
Alexander Yoakum, CFRA Research Senior Equity Research Analyst. Good to talk to you today. Appreciate the time.
Thank you.
Well, shares of China's Yihang are soaring today, up 18% here on reports it received regulatory approval for its fully autonomous passenger-carrying air taxis. The company saying China's Civil Aviation Administration granted an airworthiness type certificate. That marks reportedly a first for unmanned electric or vertical takeoff and landing aircraft in the world. Yihang hasn't specified when it plans to launch its self-driving air taxis. Shares were halted earlier this week in anticipation of the announcement. Well, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, Congressman Steve Scalise throwing a curveball in the search for a new House Speaker. Scalise announcing he is withdrawing from the race for Speaker, with this paving the way for Judiciary Chairman Jim Jordan to make another run for the position. Here with more, let's bring in Yahoo Finance's Rick Newman. Rick, the magic number is 217, right? I mean, who's closest right now to getting that?
Nobody. Maybe you should try for the job, Akiko, or maybe they should just have every Republican try on, one day after another. So Steve Scalise was the Republican nominee for like 5 seconds because in an internal vote, just among Republicans, he got more votes than Jim Jordan did. But he didn't have any pathway to getting all the votes he needed. And just as a reminder to people, assuming there are no Democratic votes for a Republican speaker, which is custom, basically. Then whoever the Republican is needs every vote, every Republican vote except for 4. That person can only afford to lose 4 votes because Republicans have such a narrow minority. And I think it was 8 Republicans who voted against McCarthy. So those 8 holdouts have not signaled that they are willing to give their vote to another candidate. And I mean, we could just keep going on and on through all these scenarios. But I mean, the bottom line here is that we do not seem any closer to having a Speaker of the House than we did whatever it was 9 or 10 days ago when Republicans fired their own leader, Kevin McCarthy. And there's important stuff that Congress needs to do that it's not doing.
Rick, ultimately, this is about the fractures that's happening within the Republican Party or the House GOP. But where do the Democrats stand right now? I mean, are there any names out there within the GOP that they could potentially throw their weight around or throw their weight behind?
I don't think it's a matter of the name. It is a matter, I mean, that is a way out of this. Remember, to win the speakership in the House, you just need a simple majority of the vote. But it has long been the custom that the minority party never gives any votes to the speaker for the majority party. The Republicans did that when Democrats had control, and that is just the way it works. So what might it take to get some Democratic votes? Well, whoever becomes the nominee in this scenario would have to offer Democrats some concessions. It would be legislation that Democrats want to see get through that they would never be able to get through if Republicans have a true majority and they just kill all Democratic initiatives, which is what normally happens. Remember, Democrats do control the Senate. So if you could get some concessions to Democrats, you could have the this is a wild prospect but the idea that you could have Democratic legislation that passes in the House where Republicans have a majority, that at the moment is less tolerable to Republicans than just this sort of ongoing chaos within their party. But if this does get to a real crunch point, and it could be the government shutdown that's looming when those temporary spending bills expire in the middle of November. But I think more than that, if there is a need to pass some legislation providing more aid to Israel, that could be a forcing function that leads to this bipartisan scenario in the House. But I think that is almost beyond a last resort for many Republicans, and Democrats would just be gleeful about that because, I mean, the minority party never has that kind of power in the House, and that would be an unprecedented win for Democrats. So I think we're still far away from that, but we're not closer to any other solution either.
Yeah, I mean, in the meantime, you've got sort of a long list of things, the agenda getting more and more packed. And as you mentioned, November 17th coming up pretty quickly as we continue to see this play out over in the House. Rick Newman, as always, thanks so much.
Yeah, Kiko.
Well, TD Ameritrade's Investor Movement Index saw a dip in September as it proved to be a challenging month for investors. Bond yields rose to their highest levels in nearly 2 decades, and the S&P 500 struggling with losses. But TD Ameritrade clients still found themselves as net buyers of equities. Here to break this all down, we've got Joe Mazziola, Charles Schwab, Director of Trading and Education. Good to talk to you today. So still net buyers, even with the choppiness that we saw in the market. Where are investors going?
Yeah, thanks for having me. I think what is insightful about this report
is it aggregates what clients are actually doing, right? What they're doing with their positions and their activities. And so what we saw was really a rotation, if you will, a rotation maybe away from some of the economically sensitive areas, discretionaries being one of those, and movements into a little bit more of a defensive standpoint. We saw that movement into healthcare. But I think my biggest takeaway was really the fact that clients were very selective in their purchases. It wasn't index or ETF buying that was really driving this. It was really more driven by movement into certain names. And, some of those names would include Apple, NVIDIA. And these are names that even in an economically sensitive regime, these are names that have good balance sheets. They have access to cash. They have good net interest coverage ratios. And so these are some of the factor analysis that I think our astute investors were looking for.
Joe, what always surprises me about these surveys is regardless of where the market is, you've got sort of these banner names that investors often turn to. Apple, one that you just mentioned, NVIDIA, another one. What about somebody like Tesla?
Well, we've seen that before, right? We've seen that before where they've moved into that name. I think the reason we didn't see that necessarily in September was just kind of the move out of consumer discretionary as a whole, Tesla being a rather large component within that sector. I think the biggest selling we really saw was kind of on leisure and hospitality. We saw that in terms of names like Affirm in terms of financing that's cost. We saw it in Airbnb. Those were big net sellers as well too. So those were the names that they kind of moved away from. Tesla just didn't really move the needle in September as much as it has in prior months.
I know we're talking about equities right now, but increasingly we have seen guests come on who talk about this exposure further to fixed income because of the yields that we're seeing, particularly in treasuries. What are you seeing among some of these retail investors about increasing their exposure on that front, particularly through ETFs?
So what I can tell you is that right now, stocks, they have competition, right? I mean, for many years, the story was TINA, right? There is no alternative. Well, there is an alternative now. Because if you look at something like the earnings yield on the S&P 500, it's around 4.75, and then you look at the 10-year yield right now, and that's just under 4.7. So basically, you're equating expectations for earnings growth, and you're trying to measure that versus what you can get in a 10-year. And with expectations for earnings, Q3 earnings to actually come down 0.3%. A lot of investors are being very selective in the equities that they choose. Like I said, this is not people buying indexes, buying ETFs as much as you're seeing them being stock pickers. And I think it's a good market for active investors right now.
Yeah, so to being a lot more discriminatory and looking at individual stocks, where do some of the energy names stand in all of this?
So actually, what we saw was a net sellers of energy in September, Exxon being one of those names. Part of it, I think, was just the rapid move that we saw in crude prices. And it seems like traders and investors maybe faded that move a little bit. And I think that their timing was pretty good, kind of considering what we've seen. Now, that was all pre or before what the conflict we're seeing in Israel right now. So crude prices are up again today, but they had pulled back, and we'll see, when the October report comes out, whether or not investors look to scoop up some of those shares.
Charles Schwab's Joe Mazzola, good to talk to you today. Appreciate the time.
Thank you. Thanks.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Good morning. This is Yahoo Finance.
Big news, 3 things that you need to know.
We just got the announcement.
What happens now?
Now I got a question.
What does success look like?
What was one of the biggest challenges that you faced?
How much does that raise the odds for a recession?
This phase is over. Tell me what happens to the debt ceiling.
Where does generative AI, though, fit into your portfolio?
Talk to us about this diversification and what investors need to know.
And I think it's important. This is the stuff that gets me out of bed, fired up.
What's the gateway? What's the new bridge to opportunity?
Doesn't matter if it's a soft landing or a hard hard landing.
Big interview. I can't wait.
Supreme Court out with the ruling on President Biden's student debt cancellation.
Right, let's turn now to some recent tech earnings. And they give you information if you watch them closely.
President Bostic, President Investors Gary Gensler, thank you so much.
Part of what Davos is about is sharing best practices, coming forward with ideas, and then enabling those ideas into action.
And I would add that there is more to come on this.
And we keep producing products that help people lead healthier lives.
This is one of those rooms they use to simulate light in space. Interest rates will come down again.
Figure out where your money is going now. You got to scope that out.
And the numbers really tell the story.
What does all this mean for you?
Keep it tuned into Yahoo Finance.
Israel's military is telling some 1 million residents in Gaza City to evacuate south in the next 24 hours ahead of expected ground invasion against Hamas military forces in the area. As the conflict escalates, the U.S. has begun operating official evacuation flights to get American citizens out of the country. Starting today, at least 4 charter flights a day out of Israel are expected. Sources telling the AP the State Department estimates 500,000 Americans currently living in the country. Global Guardian is a security company offering protection and evacuation aid to employees and their families worldwide. Since Saturday morning, Global Guardian agents have already completed 18 evacuations to retrieve more than 800 people. Let's bring in CEO Adele Buckner to explain. Dale, I imagine the last week has been an incredibly busy one for you. Where do the evacuations stand right now?
So, Kiko, we continue about every 6 to 8 hours. We will initiate another evacuation. We have a flight leaving now for Cyprus. We will continue to utilize the airspace as long as we have it. We are concerned about losing the airspace as the trigger of the IDF entering Gaza, and we do believe that is probably going to happen in the next few days. If that occurs, we have been executing ground movements to Jordan. We cannot go north as the presence with Lebanon and Hezbollah is real, and the threat is real, and the fighting is real. We cannot go south to Egypt as there's conflict there. So Jordan is our best bet to the east by ground, and we will continue to kind of ebb and flow to whatever the option is to get our clients out of harm's way.
This is a region, unfortunately, with a history of conflict, and yet you have said that this time around is different in terms of the challenges with your operation. What are you seeing this time?
Yeah, I think if you look at the last 7 years, typically these would be skirmishes that would last a week. There would be a volley from both sides. After a week or so, there would be some kind of agreement and we'd go back to status quo. That's not going to happen this time. This can go on for weeks to months, if not years. This is a trigger of violence we have not seen. And I think ultimately our message to our client base in the corporate sector and families is don't risk it. It's time to get out. It is day 6. I think if you were pending a decision, it should have been made 72, 96 hours ago. We are now getting later and later in the game, if you will. And it does get more difficult as the violence escalates. And make no mistake, both within Israel and the region, to include the West of the United States, you're going to see the violence escalate. And the pace of things is about to escalate materially.
What are you hearing from clients on the ground? I mean, this isn't, when you talk about Israel, I mean, this is a country that has a huge Western presence. We know a lot of tech companies are there, pharmaceutical companies as well. What have the last 6 days been like for you in fielding some of these calls and trying to get your clients to safety?
Yeah. Look, I think if you live in Israel and you live in this environment, you have an expectation and you expect these things to a certain degree. It is part of day-to-day life. I do believe that corporate America and the West is realizing this is different. And there's going to have to be more people moved out of harm's way. And let's see what happens. I hope I'm wrong. If I'm wrong, then this will move quicker. We will find our way to a settlement. I hope that's the case. But the reality, I think, on the ground is people are realizing this truly is different and they need to take action that they might not have over the last 7 years.
Dale, I realize you don't have operations currently in Gaza, but we have what appears to be a humanitarian crisis that's unraveling. That Gaza specifically has been blocked off from water, fuel, power running out. Now you've got Israeli military calling on evacuations to the south. Knowing what you know about the region and the challenges of evacuating, period, can you speak to the difficulty of what's being asked right now? If we're talking about getting this done within 24 hours before what is expected to be a ground invasion.
Yeah, we're talking about 2 million people in an incredibly dense area. The thought that 1.1 million of them can get up and move in 24 hours and have success at it. When you think about the amount of infrastructure, everyone's seeing the pictures in the film of what the destruction looks like inside Gaza. And it is war and it is ugly. And when you think about just the infrastructure challenges of getting around where bridges have been blown apart, where roads have been decimated, where entire buildings have been crumbled to the ground. When you see that, can you imagine I've got to move 1,000 people through that rubble or around that rubble? Even if there are paths and roadways that are still feasible where you can move and have real freedom of maneuver, you're now going to have to go around areas that have been completely decimated, or at least at some level. That is the challenge. It's not just looking at a map and going from point A to point B. It is now, what does that terrain look like and how do you navigate it? And it's hard. We're experiencing this now, and we still have relative freedom of maneuver as we're moving all of our clients to Jordan. But this, we anticipate, much like Ukraine, much like our evacuations in Afghanistan, this will get much more difficult over time. And anyone in Gaza, of course, as the violence escalates, as the combat operations escalate, this will become more difficult.
Yeah, Dale, it's a good reminder to those of us here who've been watching it unfold from afar that this isn't just about getting in the car and then going down the road with a straight shot here. We spoke to you, Dale, early on when Russia invaded Ukraine. You talk about the evacuations you had to do in Afghanistan. It's certainly been a busy year or so for you, and I wonder what the conversations are that you're having with your corporate clients about safety and how they're reconsidering where they operate throughout the world.
So I think here's really there's 2 or 3 key takeaways here. Number one, if you're a CEO or a C-suite member, a board member, geopolitics now matter in a way they haven't in decades. That's number one. Number two, if you think that you're protecting your firm, your people, because you have insurance, travel insurance, or you have a legacy duty of care provider who provides intelligence and alerts and does medical evac, read the fine print of the restrictions. They do not cover, nor do they operate in combat zones, natural disaster, or terrorist attacks, meaning they really have no coverage whatsoever. I think that reality, as you look at the pace of events, global disruptive events, the pace over the last decade is there's more every year. They're increasing in violence, and they're creating more exposure for the tech sector, the finance sector, the manufacturing sector, so on and so forth. Ultimately, these platforms were not built for the world we live in. And if you don't make material changes so that you can operate to deal with this level of violence, you're simply uncovered. And it's a reality that corporate America and the West is facing right now, that there's a real pivot required moving forward.
Dale, finally, you mentioned at the top that you're expecting the airspace to be completely shut down over the next few days. What are those next few days going to look like for you as you try to get your clients out?
Yeah. Simply put, we will pivot. We do have a ground option that we're executing daily right now to Jordan. We have to hope that the Jordanians or the Israelis don't cut that off. It's viable now. I do anticipate between the two of air or ground, we will lose the air option first. If we do, we will simply pivot and we will start running large convoys of 500 plus people at a time. And we will execute the 2 primary routes to the 2 primary crossing sites, get our clients to Oman, put them in hotels and safe homes in some cases, and then move them commercially from Oman to around the world.
How many clients do you still have that need to be evacuated?
So right now we have demand for a little over 2,000. A lot of that's come in just in the last 26 hours. So this is moving very quickly. Again, I think a lot of people, we're in day 7. People have a tendency to hesitate to make big decisions. I understand that. Governments are slow to move. If you think about the State Department announcing it's going to now fly 4 aircraft in today, why does that take till day 7? That calculation, in our estimation, is incredibly slow. This should have been moving in 24 to 48 hours, and now you're playing from behind. And ultimately, when you think about that, the movement to get people to the airport now is much more difficult. As combat operations escalate, the violence escalates, then the opportunity to move from point A to point B to get to the consolidation point and the airport is now much more difficult, even if the airspace remains open.
Dale Buckner, Global Guardian CEO, some really important perspective there. Appreciate you joining us again. Appreciate the work that you're doing on the ground there.
Thank you, Kiko.
Well, all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Well, this week, California Governor Gavin Newsom signed a zero-emission bus mandate. It calls for all new school bus purchases or leases to be zero-emission vehicles after 2035 in the state. California isn't alone, though. It's following a similar path as Connecticut, Maryland, Maine, and New York. More on the growth of zero-emission buses and trucks. Let's bring in Fraser Atkinson, CEO and chairman of Green Power Motor Company. We've also got Yahoo Finance reporter Praz Subramanian joining us today. It's great to talk to you. We have seen this gradual push towards zero-emission vehicles with school buses, but how much of this would you say has really been spurred on by the IRA?
Well, I'd say it's being more directed by state as well as the federal initiative that was announced several years ago that's already provided funding under the EPA school bus program. So I think it's multifaceted, and really there's a lot of advocates that have helped propel the electrification of school buses.
Hey, Fraser, so you guys are, I understand, you're going to start delivering some of these school buses in West Virginia in December, but you also had a pilot program going on with those buses. What are some of the key learnings you guys have sort of seen with operating kind of like heavy duty or medium class types of vehicles with electric power?
Well, there's probably we learned or we had a number of items ratified that we knew of, but not the extent of. And what I mean by that is in the colder weather, EVs don't perform as well in terms of the range, in terms of the fact that the heater draws a lot of energy. Other than the traction motor, heaters draw the most of any other system on board the electric vehicles. And so that is something that we're adapting to in terms of how we can minimize or reduce the impact of the colder weather on an EV. And the other was infrastructure, that fortunately our vehicles are multifaceted in that they can accommodate both a level 2 and a level 3 DC fast charge. So we can set up our charging based on what is available. And with school districts, their depots are already largely operating at the max. So coming in with electric vehicles, where we need to install a lot of charging stations, has a significant impact on the ability of school districts to electrify in certain locations.
Fraser, what does the cost differential look like when you compare specifically EV buses and trucks to their counterparts, ICE cars?
Well, the capital cost is roughly double the equivalent ICE vehicle for a diesel-powered school bus is the equivalent for an electric vehicle, whether it's on this picture here, we have our Nano Beast, which is our Type A 25-footer, and our Beast, which is our larger 40-foot that can accommodate up to 90 passengers, and those are roughly double. But the other factor is that unlike other sectors that we deal with, such as in the commercial vehicle space or the passenger vehicle, where operators are looking at running our vehicles for 12, 14, 16 hours a day, with school buses, you run them in the morning and you run them in the afternoon. So the utilization of the vehicles is less than other sectors, and that impacts the overall return or the how you would evaluate your total cost of capital and operating costs for each vehicle.
Hey, Fraser, so what are some of the key challenges you guys have faced sort of ramping up and building these buses, whether they're school buses or other types of mass transit buses? Is it securing batteries? Is it the cost of those materials? What are some of the key challenges here for your business?
Well, on the supply chain side, it seems like there's always a new challenge every 6 months. Right now we're going through, believe it or not, a shortage of seats for some of the configurations and layouts that our customers are seeking. And those delays are in the magnitude of 16, 18, 20 weeks to get the seats, which impacts on your timeline on the production flow. From the deployment side, especially with school districts that have never had an electric vehicle before, there's a steep learning curve. And as I alluded to before with the charging infrastructure, that is a challenge with some school districts where they order a vehicle, we're ready to deploy, and then when we're engaged with the company doing the installation of the charging systems and dealing with the utility companies, we're told that that's going to be 6 to 9 months before the charging will be up and running and ready to accommodate the vehicles. So in some cases, we've provided short-term solutions to allow the school districts to get their vehicles on the road.
Fraser, there's certainly been a lot made of climate tech startups and the challenges in operating to get to a point of profitability. We saw Proterra, which was also a electric bus company, file for bankruptcy a few months ago. Are we finally at a point where the market is catching up to where those ideas are?
Well, I think the EV market itself, and when you look at, I define it as the medium and heavy duty the manufacturers, which is the space we're in. But in the case, if we did a candid comparison of the two businesses, we have put up a gross profit on the sales of our vehicles every quarter for the last 3-4 years. And in the case of Proterra, they were running their business with a gross profit loss. So before even accounting for the expenses of the business, they were losing money on every vehicle that they sold or every aspect of their various divisions within that company. So we're a little unique in that there's not many companies that have consistently put up a gross profit. And we've been operating a very lean structure in terms of managing the business and not trying to overextend ourselves into markets that we can't afford to be in.
So speaking of managing the business, can you talk to us about sort of the demand picture with these buses? I know you have some programs in different states like California, Connecticut, and West Virginia. Where else are you expanding? And a second quick question also is, who are some of your strategic partners, like tech partners, that you're using to build these buses?
Well, we do on the production side, we do a lot of contract manufacturing, which is the similarity I would draw is that when you buy an Apple product and open the box, it says designed in California. Well, in many cases, those are made all over the world. And in the case of an Apple iPhone, they make it in Shenzhen in China, but it's still managed. That whole production is managed by Apple, and that product is designed and deployed and supported by Apple. And there's a lot of similarities with their business model in terms of how we've arranged our contract manufacturing. In terms of the demand side, that's really the big opportunity for our entire sector. In that, you look at New York that you mentioned in terms of one of the 5 states that has a mandate to electrify their school buses. They have over 50,000 school buses in that state. It's over 10% of the entire school bus fleet for the nation is in that one state. And they came out with a mandate a year ago to effectively electrify all of those by 2035, with new school bus purchases starting in 2027 being all electric. So we're on the state contract there with both our Nano Beast and our Beast. And in some categories, we're the only vehicle that's available. So we're having to look at ramping up for future demand that hasn't quite hit yet, but is coming. And so that the challenge for us is to build out our business to be able to meet that demand in terms of supplying vehicles on a regular basis.
Well, we'll continue to follow your growth story there. Fraser Atkinson, Green Power Motor Company CEO, Chairman, and Yahoo Finance reporter Prosty Romanian also joining in on the conversation.
Thanks for having me.
All your markets action ahead. Stay tuned. You are watching Yahoo Finance. Netflix is getting hit with a downgrade this morning after Wolf Research slashed its rating on the stock, saying the risk reward for the streaming giant is, quote, balanced. So what is the signal ahead of a key earnings report for Netflix? Yahoo Finance's Ali Canal on top of that for us. Ali, steep loss today, at least more than 2%.
Yes, and you normally don't see these downgrades for Netflix, but we did see that this morning from Wolf Research, as you mentioned, downgrading shares to peer perform from outperform. And the analyst also removed his price target on shares, which were previously one of the highest on the streets at $500 a share. The analyst, Peter Supino, said his biggest concern revolves around Netflix's growth forecast for 2024, given slow adoption of the ad tier, along with the recent shortfalls around average revenue per user, which is a key metric when you measure profitability. Now, management has also warned that over the near term, there's going to be less margin expansion. That was a big disappointment to investors. So there are quite a few risks out there that seem to cloud the longer term outlook for this company. And when you think about the landscape around streaming, there's a hefty amount of competition. Netflix will likely raise prices. It has already eliminated that middle $9.99 subscription tier. So that makes the discrepancy between the ad-supported tier and the ad-free tier more prominent, and that means less choice ultimately for consumers. So considering the current valuation of this company, the streamer really needs to make sure it's keeping up with its content cycle. It's upping that engagement. It's driving those new subscribers so that those rewards can ultimately balance out the risk of growth expectation reductions. And if we take a look at shares, like you said, they're down about 2%. We're up 20% on the year, but down 20% over the past 3 months. So investors have been a bit more cautious, and that means next week's earnings will be especially important with all eyes on those margin figures, that ARPU, along with any new details surrounding the impact of the password sharing crackdown, along with the ad-supported tier. I think we're just hitting a point where investors want specifics. And although Netflix has repeatedly said that these revenue initiatives are longer term initiatives, there just needs to be a little more specificity when it comes to the upside here.
Yeah, now that we've got the WGA strike over, obviously SAG-AFTRA is still having to negotiate their contract. What are you hearing from analysts about the impact that they have seen on a company like Netflix?
Yeah, I think that's critical for Netflix. They are a company that relies on their content. At the end of the day, content is king. And the longer this actor strike goes on, the more that's going to affect these various studios. So hoping for a quick resolution. We'll see if that can get done. We're at this critical moment in the fall, and we only have a few more months before the end of the year.
Yeah, we'll be listening for any commentary on that front as well when Netflix reports next week. Ali Canal, thanks so much. Let's do a final check of the markets before we let you go. Going into the noon session here, red arrows across the board with the Nasdaq seeing the biggest losses here, down about 1%. Tech sector also seeing the biggest losses on the day, but energy getting a big lift on the back of higher oil prices. Take a look at that. We are seeing oil futures, WTI futures up more than 4%, as is Brent crude there. This coming on the back of U.S. tightening sanctions against Russian oil, that broadly adding to supply concerns in the market. That does it for me in this hour. We've got much more to come here on Yahoo Finance Live. Keep it right here.